deep discount, but did not take out these lows over here. But look how we closed on Monday. We had an indecisive candle. The body was basically absent. The open and close was essentially the same thing. If we have that and the market's trading down into a discount, even though we might have a low down here that we're targeting, this may require a retracement. Now notice at the close of Monday's trading, we had an imbalance from this low and this high. On Tuesday's trading overnight, the equities markets had a run up into this imbalance here. So this fair value gap was retraded to in here. This low and this high, we'll look at that in reference to the lower time frames. This lower level is the low end of the fair value gap on a daily chart. And this level up here is the upper end of the fair value gap. I'm taking your attention to Monday's trading. And I want to talk a little bit about Power 3, which is accumulation, distribution, and manipulation. Okay, so generally my teachings are like this. If I'm bullish, I'm expecting the opening price to be near the low of the day or the session. Then it trades lower, making some important low, and then rallies, creates a high, and then closes near the high of the day. Now, it's not important for you to try to predict the closing price. What I'm trying to train you to anticipate is the likelihood of the market making some kind of a fake move, like a Judas swing. Okay, a Judas swing is the false move. Typically, in London and in New York session, there are fake runs that start off a move. And I walked you through it last week on my community tab, where I outlined the actual Judas swing for that particular day. Using the fair value gap, outlined the low. I was only off by a quarter of a point for the low end of the range, and it created the low of the day. The idea is what I'm going to show you here as well. On Monday, we had a price drop down overnight, consolidated, and then we have a little bit of a rally ahead of the equities open. Okay, so in here, we have 8:30 in the morning. If you look at 8:30, what do we have? We have the highs over here. They're suspect because they're relative equal highs there. But look what we left here ahead of 8:30. We had this huge imbalance. So if we run these highs out after the open at 9:30, it's likely to trade down into that and rebalance. But watch what it does. And we trade up into that level here, which creates the fair value gaps low end parameter. Remember, this is Monday's trading. It sells off. So this line isn't here on Monday. That's not what we're looking at. We're looking at the likelihood of coming back down into this area here after taking these highs out. If it does so, if it trades back into this imbalance, that's a good candidate to go long. Now, the imbalance in here, if you go to the left of it, you can see the down close candles. That's your bullish order block. The market trades down, hits the order block, and it's an afternoon trade. So it starts to rally and then consolidates into the close. Overnight, we create a wicked run last night. It ran last night, and most of all the move for today was done before we even got to the opening of the morning. Had a little bit of a retracement after 8:30, and at 9:30, we consolidated. I'll talk a little bit about that as a market profile in a moment, but then we drop down, create an important low of the day, and then we rally. It got real close to the fair value gap's high-end parameter, but didn't get to it. We don't need, it's just like I was mentioning here, you don't need to try to predict the closing price with Power 3, which is accumulation, manipulation. So in other words, if you're bullish, it opens where you think it's going to trade higher. It's going to be most likely a small little move lower. That's the move you want to try to go in and hunt along. If you miss it, you want to try to get long real close to where the opening price is. Now the question is going to be is where is the opening price? Well, I like 830. Okay, you can use the opening price here at 830. Draw that out in time. Did we go below it? Yes. Did we go inside the imbalance? Yes. Did we take out a short-term low? Yes. Did we hit an order block? Yes. Was it an optimal trade entry? Yes. Lots of factors there. Over here, same thing. Opening price here. Did we trade lower than that? Yes. Did it go even lower than that later on in the afternoon? Yes. And then it rallied, taking out the relative equal highs here. And again, gravitating towards that upper end of that fair value gap on the daily chart. Now I'm in a 5-minute chart on that same February 14th, and I want to take you closer to what price has done here. That imbalance, the lowest portion of it here with all the down closed candles here. Now this is anchored to the daily bullish order block, but you can see how we traded into it here with 1, 2, 3, 4 down closed candles. That is a complete order block on this time frame. So consecutive down closed candles right before a price surge that has an imbalance. That's how you find your order blocks. Okay, so a high probability order block would be your narrative or your bias is bullish. You're looking for displacement. That's this right here, where the market runs real quick higher. And the down closed candles, you want to mark that out and anticipate a return back into that. Now, again, this level is not there yet. We don't know this level until Monday's close. So don't be tricked thinking that I had this level here and I knew it was going to go right to that level in terms of, I'm not suggesting that at all. What I'm suggesting is watch what happens when it creates that high. It breaks down. All of this price action here gets overran into a retracement back down into this imbalance here. The low of this candle and the high of this candle, that right there, that's your fair value gap with an order block and optimal trade entry. Rallies, even though it's sloppy, it's still continuously driving higher. This high at the close on this day here at say 4:30. Okay, 4:30 in the afternoon, to me, that's like the close for me. Now it trades a little bit later than that and then closes for a little while, and it also technically closes when the bell rings at 4:00 p.m. Local time in New York. Because there's a little bit of trading past that, I like to just look at 4:30 and just consider that where we are in terms of what we've done for the full range, and then determine what I have left for maybe imbalance or liquidity pools. Here is that drop down here on a 1-minute chart. It's digging into that order block right here. If you look real close, let me go back up one slide. I want you to see what I'm showing you here. Right here, this price action, see 14,140, 14,120. This little area right here, I'm looking at on a 1-minute chart. 14,140, 14,120 in that vicinity. See that small little gap right there? See that? See the swing high? We trade above it, create a fair value gap there, trade down into it. This is an afternoon trade. This is 2:00 in the afternoon, local time in New York, inside the order block, inside the fair value gap, inside a retracement of the fair value gap that sets the stage of a market run up into a higher retracement. Now, we don't know if this is going to be the closing parameter for a daily fair value gap. We don't need to know that yet, but this is a likely scenario to go along, and we can look for a run back up into this range here, or run the buy stops above here, or maybe inside here. Sloppy run, but nonetheless, it's still pressing higher. Now, here's today on the 15th of February, 2022. Notice what we had. We had this enormous price run overnight in technically the London session. Now, a lot of you are going to ask, would I have caught this? No, No, I wouldn't have caught it. I would have missed it. And if I was awake, I wouldn't have seen it coming. Let's just put it that way. So this right here was a complete surprise to me when I woke up, saw it. But I want you to think about when you have these overnight runs that were basically these big moves overnight before the session begins in New York. When you're trading equities, this also works with forex too. So it's important. Try not to chase price. This is what I mean by don't chase it. Don't chase it. Last week, when I was commenting and outlining the NASDAQ and giving the fair value gap real time, explaining to where I thought I was going to draw down to, and it created the New York session low of the day. Okay, that's what I was outlining. Just take a look at it. Go back and look at it. You'll see it's pretty obvious. The same logic, I'm amplifying that here. Okay, overnight, what was the market doing? It was rallying. So when we open up at 8:30, do we go in here and start buying it just because it's gone up overnight? No, we don't chase it. You have to wait. No, we don't chase it. We have to wait for more information. What information are we waiting for? Well, typically, whenever you see a big run up or a big run down, there's a consolidation that takes place shortly after. Now, not always. Sometimes it just keeps on ripping higher or lower, and you'll either miss a move, or if you get lucky, maybe you can participate in it. But this is what I typically look for. So if there's a lot of range movement overnight, what's overnight? 2 o'clock in the morning to 5 o'clock in the morning. Okay. If we get a big run like that, which is what we're seeing here, right away in my mind, I'm thinking, don't trade a lot. Don't expect a lot of in and out, perfect precision. Wait for a real significant price move. Otherwise, you're going to get chopped up. Now, what does that mean? Well, when we have it opening here at 8:30, look to the left. What do we have? We have this high here, and we have the low over here. We can use this one because they're relative equal, but I like this one. Why? Why do I like this one? What's below it? Fair value gap. See that? So it's likely to trade down after it creates this sloppy opening. Look at all this movement in here. Now, as a personal study, there's 2 or 3 YouTubers that I watch that trade the equities market indices. And I'm not trying to say anything bad about them. I just like to listen to what they're thinking because they don't look at the market like I do. I'm not suggesting that they're not profitable because they show live trades. They get in the trades, they take them, and sometimes they win and sometimes they don't. But I like to read, kind of like a squawk box, what their interpretation of price is. And they're looking at this area in here, and it's back and forth. They think if it goes here, it's going to go there. If it goes here, if it's going to go there. It's all these scenarios they're going through, randomly in their live streams. So when I'm watching price, I'm listening for them to want to be a buyer. So when they're trying to be a buyer, that means they're already hunting a continuation of this move here. I want to see a low form. Now, this is what we have for today. We start going lower first, so that's good. We create a pseudo Judas swing. But did it create a nice low and turn away from it? Look at all this back and forth. And it created these suspect lows in here, relative equal lows. There's going to be sell side building up below that, sell stops. Okay. When it starts to go higher, anyone that was long overnight, they're going to jam their stop loss right underneath that. Okay. When this occurs, that's the very scenario I'm looking for. Now, right away in my mind, here's what I want you to understand. If there's a big move overnight for equities, this is not forex. Okay, this part is not forex. It's just for trading like NASDAQ, Dow, and even the S&P. If there's a big run overnight, avoid the New York session. Don't even mess with the New York session. Wait until the other side of lunch at 1 o'clock in the afternoon, New York time, and then anticipate the New York lunch lows taken out or the New York morning session lows, which is what we have here. Notice how we rallied up. We didn't take out the relative equal highs here that was formed ahead of 7 o'clock in the morning. Notice that? Now, this over here, we know this range up here is the high end of that fair value gap. Why do we know that? Because the 14th stopped trading and it had the indecisive candle in the daily chart. So it's likely that we might trade up into this range high, and this is that range low. So if we can draw down below that low it's formed initially in the New York session, we have a fair value gap over here with sell side. While we have yet to take out the buy side liquidity here at around, I don't know, 14,575, and then get up to that fair value gap high, or the boundary of it, okay, kind of like the resistance level of it. So this is the draw on liquidity, and we have a minor draw on liquidity here with buy side liquidity. Look what we have in terms of price action. The NASDAQ drops down, taking out the sell side, digging into that fair value gap. See that? Look at the bodies of the candles. Isn't that neat? How it just respects that level back here. Now, that's not random. Okay, these are algorithmic principles that are in play. And these markets are unbelievably precise when they are in better conditions. Right now, if you've been trading with live funds or if you've been trying to follow price action, there's been a lot of, it makes a run, then it goes into this choppy sideways. And it's very frustrating if you're trying to get like sustained price moves, or if you don't know how to operate in these, like these sloppy little ranges like this. I personally don't think that this is high probability trading. You can get chopped up, you can get losing trades, you can draw your account down. If you don't control yourself, you can blow your account in these types of conditions. How do you avoid that? How do you avoid running out your account and then scaling back? If you're a high frequency type of a trader, how do you draw back on the frequency and look for the better setups? What I'm showing you here. You wait. You don't chase the overnight run, and you wait low that everybody overnight will want to put their stop loss right beneath that after it starts to rally above it. It's even better when you don't have this high taken out yet. See how I took it up here and it just went right down for them. That's engineering liquidity. It runs up, consolidates, creates a low, starts to rally, and everybody's thinking, I don't want to lose my profits. I don't want to lose out on making more money, but I had to put a stop loss right here because the books tell me I had to do that. So I did the same kind of stuff, folks. I'm not trying to talk down to anybody, but I'm just repeating what a retail trader's mindset would be and the logic behind this. Okay, so the narrative with this day was the stops were trailed below these lows. The afternoon session again creates the low of the day, takes the sell side liquidity out into a fair value gap, and then rallies. Now in here, I'm going to teach you a little bit more about that. Watch. Notice we don't really have a fair value gap down here, but it gives us the basis for expecting the price to start to rally into the afternoon. Now, at 2 o'clock in the afternoon, 1400 on this trading view chart, that starts 2 o'clock in the afternoon, New York local time. We have the market trading down into an imbalance over here. Liquidity resting below these relative equal lows is taken out. So what are we looking at? We've seen a price run that we don't think needs to come back down here because the logic is the overnight stops have been ran out down here. There's no reason for the market to want to come back down there. But we have this low and these relative equal lows here post New York lunch. New York lunch is noon to 1 o'clock in the afternoon, New York local time. So the imbalance, we trade down into that. What's the likelihood of it coming all the way through the imbalance and then going after that low? Not likely. Not likely. Not after seeing this run here. They don't want to give these traders another chance to get back in. They got stopped out. So it's going to be a little bit more sneakier when they make these new setups to continue into a higher run. So they take out the sell side below these relative equal lows, take those stops out, and then it rallies, and it drops back down. Now here, watch. We have a swing high right here. It breaks it. Does it trade above that? Yes. Was it energetic? Yes. Does it have a fair value gap? Yes. So now the market trades down into it here, creates a short-term low. You could be a buyer there. There's nothing wrong with that. But say you missed it. Say you just, I mean, this is a 1 minute chart. Say you missed it and the market starts to run off like this. But then it gives you another opportunity. I've had many times trades form just like this, where I was looking for something, I was waiting for a setup to happen. Either my cell phone's buzzing or I grab a drink. It's just outside of reach. I got to go walk over to the other end of the desk, grab it, and then all of a sudden, here you go. I miss it. It takes off. The fair value gap is even better when you have the sell side liquidity resting below a short-term low. And the drop down into it here, you can use that low as your entry, or minus one tick. Okay. This short-term low forms at 2:34 p.m. Now, if you look at the low figure up here, that value represents that candle right there. So that's why you see it highlighted here. When I took a screenshot, I'm holding underneath this candle, so that way the reference points up here are directly related to this candle. So you can see the low is 14,528 and a half. So you could be a buyer on a limit at 14,528 and a quarter, or maybe if you want to try to reach for the the 28 even number. Either way, that's a nice place to put a limit order in. The short-term low down here, after the fair value gap forms, that's where your stop loss is. That's the rules. So you have an entry point, your stop, and between the two of them, it works out to be, okay, let's say you have 14 and a quarter in terms of risk. Okay, so 14 and a quarter points or handles of total risk. And let's assume that you were trading, I don't know, 6 contracts on the micro. You're essentially looking at buying and risking $85 to make about $300. So it's about 3.5 to 1 reward the risk. Thereabouts. I'm roughing. I don't have a calculator in front of me, folks. Just do the math. Now here, this value is important because I want you to see in these conditions, you can't expect it to be perfect. You can't be, expecting to be in there at the lowest point, no drawdown, no heat on the position, and then it just goes in your favor. Don't think like that. You can see on this candle, if you would have bought here, you would have had 9 points of heat, okay, or basically $54 if you were trading 6 micros. Now, obviously, it goes up more than that if you're trading 1 mini because it's $20 per handle. But overall, this is a nice little setup with the afternoon using the logic over here, even though it doesn't give us a fair value gap, the setups that I'm teaching you to use, using the fair value gap, afternoon, taking the stops, it provides the baseline for bias for the afternoon. Now, what did I teach you here? I taught you that you can use these reference points with the underlying sentiment that's already in motion. If you didn't trade overnight and take that big run, I didn't get any of that run. I didn't do anything with that. If you missed that, it doesn't matter because that is something that's going to give you more insight. And it tells you when to avoid the morning session. Don't trade it. Everybody's going to be doing what? Think about it. Everybody woke up and saw these markets and they all wanted to do what? They wanted to buy it because it's going up a lot and they want to chase it. That idea leads many times to losing trades, and then it starts this cycle where you go into this chasing, and then when the market does these sideways consolidations and sloppy, choppy market conditions, it's literally like a blowtorch on your account. If you don't know how to stop, or if you don't know what you're doing, you can literally talk yourself into millions of trades and then draw your account down. Last slide, and just to hammer this down. This is zoomed in on a 1-minute chart. Swing high, broken, fair value gap right there. And we have that short-term low here. I'm noted in here. So that's where you would be basically entering one with that idea. Trading below that is where the sell stops are. Trading below that. Now it goes below that. Now, some of you have mentioned in the comment section, does this invalidate the fair value gap? No, it does not. The idea is the fair value gaps. Well, look at the body of this candle here. Isn't that respecting that? Yes. So in my mind, I'm thinking, well, I know prices sometimes, especially the way it is right now, it's very volatile. So I'm permitting a greater level of imperfection in price delivery, and then using the logic of the fair value gap as the basis for my entry idea. And then using the stop premise which it didn't get it here. It didn't stop you out. You had basically what, five, what was that, five or so more handles before you would have been stopped. Now, watching it live might make you a little nervous, but at some point, folks, you're going to have to get used to. If you're going to trade like this in these really little time frames, and you're trying to be very nimble, you're going to have to learn to trust the setups and let the stops do their jobs. And if it gets stopped out, that's just one trade you got wrong. It's not your career. Look for the next one. Now, I'm going to throw this in here as a bonus, but take it for what it is. It rallies here, takes off, and does not take out that the buy side liquidity resting above here did not get taken here yet. And then we had this imbalance, and it trades down into it, and then it hits what? The order block. That's a buy, and you can, if you miss this one, you can pick up this one based on the logic I teach on the YouTube channel. So this is actually something that's taught in the YouTube channel. Okay, this whole pattern here is exactly right out of my high probability short-term trading or scalping series. I can't remember exactly what the title was, but this pattern here is right in that. And then it runs for that liquidity there. So there's two setups there. So I took something from the free lessons that's already on the YouTube channel and also amplifying something I've been teaching in this mentorship series. Hopefully you found this one insightful. And until I'll talk to you next time, be safe. All right, folks, welcome back. This is episode number 10 of the 2022 ICT mentorship for the YouTube channel. This lecture is going to be teaching implementing economic calendar events with the open. All right, so the economic calendar, many of you probably don't even consider looking at this, but it's important if you're going to be learning how to speculate, study these markets. Certainly, if you're ever going to consider putting live funds in, you're surprised, unfortunately, adversely, with a sudden rush of volatility that you wouldn't otherwise expect. This is Thursday's economic calendar for Thursday, February 17th. And not all of these things are going to be heavy hitters for stock indices, but most of them are. And what I'm showing you here is what I teach all my students. I go to forexfactory.com. I use their economic calendar. It's not the only one you can use. It's whatever you like. I like the color scheme they use. It's just a personal preference. You can pick any economic calendar. They're all going to pretty much say the same thing. Here, the medium impact events are like orange, low impact are yellow, and anything that's red, which is not being shown here, would be like a high impact news driver. So when we look at these stock indices, the reason why I teach you 8:30 in the morning, like that's your beginning time to start looking at it, or crosshairs time. The news embargo lifts at this time at 8:30. Typically, there's a bunch of news events that are being ushered into the marketplace at that time. Now, some of these reports or speeches or data points, they may be used as a smokescreen. They may be used as a catalyst to have price go up or down at the time of their release. Other instances, like I'm going to teach tonight, usually there's going to be a build-up or a dropping down in price right before the report comes out. And then the real move starts to ensue. Okay, so it'll make more sense as I get into the actual teachings. Okay, so we're looking at the NASDAQ daily chart. This is the TradingView continuous charts. That way you'll know what I'm looking at here. It's the one we've been working with in this mentorship. So the daily chart, when I'm talking about Power 3, a lot of comments came in the previous video mentioning how it was confusing to them because obviously they're new. They just found me. They don't know what I'm talking about when I say Power 3. I actually have a teaching in the YouTube channel, so you can look it up and study it. But I'll give you a little bit more amplification here. Also, kind of like help bridge the gaps in your understanding about daily bias. Because if I could tell you what was the most requested question over the years since I've been mentoring people, Without a doubt, absolutely, without a doubt, the number one question I get is, ICT, can you please teach me the daily bias? Can you tell me if it's going to be an up day or a down day? And I'm going to teach you here, and this is my honest to God's truth. Okay, I'm never going to be able to do it any easier than this. Okay, you just have to study price action and you'll see it for yourself after a while. But this is really all I teach my students, and it is nothing more secret to it. This is it. Okay, it's just the brass tacks of looking at what the daily range is likely to form. So right away, we're looking at the daily chart, and as I mentioned in the previous episode, I outlined this high here and this low, and that was the range we were within. And the 50 level was equilibrium. So again, above equilibrium is what market, and below 50% is a discount market. So we traded back up into the top end of the range between this low and this high, and between these two levels here. Remember, I gave you this low and this high. That's a imbalance. Okay, it's a fair value gap. This market was down in a discount initially after we had that indecisive candle. Go back and watch the 9th episode. If you haven't watched that one yet and you're watching this one, it's going to feel like even more confusion. But we had an indecisive candle here, and we were in a discount. Even though I believe, and I've been telling my own students that I believe we're going to clean out these lows down here, we went to a discount relative to the dealing range between this high and that low. So below it, we're at discount, and we have an imbalance. So it's likely to do what? Go back up and rebalance this before going back down. Listen to what I said in the episode number 9. I said, even if we trade back up into this range, there's trades you can take even if we believe that it's going to go below those lows. That's me tipping my hand to you. I'm not trying to provide you signals. I'm not going to tell you buy here, sell here, put your stop here, take your. I'm not doing that. In the community tab on my YouTube channel, probably once a week, I'm going to point out something in a chart right before it happens, and I want you to try to study it. You may not be able to see it real time. You may miss it, come to the YouTube channel after work or whatever. Maybe you're sleeping and you couldn't see it at the time. But still go through your charts using the information I'm providing you. I get asked all the time, can you please put a date and time reference in the post? I forget. I try to remember doing it when I wake up if I'm going to post anything, but something happens and I see it in the chart and I must want to put everything in the post and I forgot it. So I apologize for that. It's a work in progress, folks. So if we look at the reference points of it being in a premium market or a discount market, but then we have this imbalance and we have a bias and it's likely to go down and take out these lows. So what do we said here in short? The market's been going lower. Yes, we took out some sell stops below this low with the sell side liquidity being taken out here. Then a natural retracement, which is reasonable. Then we start to decline. Then we come back up one more time. Failure swing doesn't go above that high. And then it breaks down and it creates an imbalance when it takes out this short-term low. Wow. That's kind of like the model I'm teaching you. Yes. Now, what's the framework here? We rallied, broke below a short-term low with the model suggesting that these lows may be taken out. So any rally or up-close candle or candles should be viewed as a potential shorting candidate. Now, ring in the imbalance. We traded up into the imbalance. One more day, we swept above it, not by much. Then the next day, we open, we rallied just a little bit, and then plunge. We took out the previous day's low and the day before its low. So both of these daily lows have been cleaned out. Now this one is the next one. Then down here. So when I talk about power 3, I'm specifically dealing with this time frame, the daily chart. If you consider where the market opens, say this is the opening price, and in daily range, if you're expecting it to go down, or maybe you weren't expecting it to go down, you were just looking at the price in your chart, and you see that the opening was here, it rallied a little bit, it went down, and close near the low. Now, that's a rather simplistic overview, just making it very plain, nothing terribly exciting about that. But when you really start to consider it, it is really exciting because this is the market right here. If you understand this and you can study a daily chart, daily bias will become easier for you if you start implementing it with this mindset. So if we're bearish, okay, if we're bearish on the market, we're going to anticipate the daily ranges or each one of these candles doing this very thing here. Open, a rally, not much of a rally, but it can make a large wick. It doesn't make a difference. But the general premise is it goes up just to go down and it closes down near its low when it's bearish. Obviously, this would be reversed where the open would be down here near the low and the close would be near the high of the daily candle if it's bullish. But not every single candle in a series of the entire price swing is going to be all up close candles when you're bullish. Conversely, not every candle is going to be a down close candle when you're bearish. But I've already taught you when you have these sustained price swings on the higher time frame, you're not seeing a lot of up close candles when it's bearish. You're not seeing a lot of down close candles when it's bullish. But contrast that with what you may be feeling when you're looking at price. You'll make a big deal out of one down day when you've been bullish, and it completely takes you out of your game. Oh, I can't determine bias. I don't know what's going on. This is always tricking me. I felt that too in the 90s. I know what it feels like. But let's take a closer look at this. This is the chart that I used to trade back in 1992. The classic open, high, low, and close bar, which is what I'm showing you here. Now, with this chart, it made perfect sense to me. And if my eyes were not as poor as they are now, because I'm aging and I've been looking at computer screens for 30 plus years now, it's worn them down. So obviously candlesticks are a much more preferred way of looking at it because it's thicker. You can see the open and close relationship as I'm teaching you here a lot easier versus this. You have to strain to see where the opening is on this candle. Is to the left of the candle or not? It's not even a candle, it's a bar. So to the left of the bar is the open. It trades down, creates the low, rallies up and closes near the high. See that? Same thing here. It opens, trades down, goes up and closes above the opening, but in the upper portion of the daily range. Then we have a high where it doesn't really matter where it closes. Then it's likely to do what? Come back and rebalance this. It'll make sense in a moment. It opens here, small little rally up, creates this very thing here on this day. It opens, small little rally up, and then down, overlapping this daily bar. If we look at this relationship over here, we have this one single pass with that bar range between this candle's low and this candle's high. That's our fair value gap. The market can trade back up into it, and look where it closes, right on the highs. In the next candle, it's back and forth, works both sides of the range. But what is our bias? What's our hint at? The bias is bearish. We're looking for these lows to be taken out. So the only thing we were doing was come back up to rebalance this, then go lower. So once we went back to the top of the range, did this candle or bar touch this candle's or bar's low? No, just fell short of it. This wiped back and forth. So now this range here is completely balanced. So there's no reason for this price to hang around. Now, it could have went a little bit higher today, and I was waiting for that to potentially happen, but I've not abandoned my bearishness for price to go down here. All my students know that. This movement here, we have the open, the rally up, fade it, comes back down and closes on the low. That's this pattern right here. Power 3 is accumulation, manipulation, distribution. Okay, that's the 3 components. The power aspect is if you understand those relationships on what the daily range is doing, the open on a day that's bearish, okay, the open and anything above it, that is accumulation of shorts. Now, it's not limited to just open and above. That's the that's where smart money and people like myself and my students, that's where we're aiming to enter getting short. It can be whatever the range is. This is important because my students are actually going to smile when they get this too. The open to the high, whatever that range is, you take that range and you subtract it from the opening price. That is your opening range. That's where your fair value gaps, that's where your stop rates are going to happen. That's where your optimal trade entry is going to happen. Every potential shorting candidate, whatever system approach that I teach, even in my paid mentorship, every premium array, okay, that's what I teach it as. Every single one of them will reside and form in the range between the open and its high. In other words, if you're watching price and you're bearish, the day opens up and then it rallies up. That's a Judah swing. The range from the opening price up to that high, that range is what you project below the opening price. That is your opening range. When I say opening range, that's opening range. So what that does is gives me an area at which to bracket out how much leeway I can give the market when it starts to go below the opening price and still take a favorable entry. Because power 3 is I'm bearish, I'm expecting the market to open and rally above. If I can get something on short there, that's the ideal scenario. But I may not be able to do it. Or I may take a trade early or just take a trade and I get stopped out. It's going to happen. But then it breaks down below the opening price. Does that completely ruin the day for me? Sometimes it'll just tear off and I can't catch it. It doesn't give me a setup and I just miss it. And you can't chase it and don't worry about it. But don't be upset. Just go back in your back testing and you'll see that there's lots of opportunities coming in just below the opening price. This is called close proximity entries. This is what I promised in this mentorship on YouTube. Teaching you in the mentorship community, I already know most of you that have recently found me, and there's been a lot of you that just came on. I appreciate all of you joining me, but you don't know all the things that I've been teaching on this YouTube channel. So you feel like you're drinking from a fire hose right now, and it can feel like it's tearing your face off because it's so much information all at one time. And leaves your head spinning. Like this guy keeps talking. I don't understand. Get to the point. The point is you need to have layered understanding. And if you're not going to be patient and go through the content properly, I'm not going to help you. I'm going to frustrate you. And you'll probably come back to me later on and then learn properly and wish you would have stayed and did it the right way the first time. But that's for you to determine on your own. Having the opening range, when you're bearish, whatever the high is, from the opening, project that down. Your sell setups are going to form in that. That is accumulation of shorts. The manipulation is the initial rally up. That's the sucker play. That's typically the breakout artist thinking, oh, it's going to go higher. No, it only goes up just to go down. That's a fake run. Then it goes lower, creates the low of the day, and then closes near the low of the day. So between where the low of the day is and where it closes, that's distribution. What's being distributed? Smart money's short positions. So they're selling at the open and above or just below it, riding out the daily range. When it creates the low of the day, how do you know when the low of the day is formed? Well, I've taught you time references. So if price has been really taking a beating going lower, and you're getting towards the end of the day, like 3:30, 3:45, something like that, it's probably really close to the low. Not all the time. Sometimes it creates a real fast, sudden continuation. And if you're not expecting it, or if you're offside, it can be bad. But if it's one side, it's really fun to be a part of that. But generally, it's the last portion of the trading day, and it'll create some kind of a low. And then wherever it closes, between that low and where it closes, that's where the distribution cycle is occurring. That part is not that important. The main thing is understanding what does this candle have the highest probability in terms of forming? An open, rally, sell off, and close down on its low? Or is it likely to create an opening, trade lower first, then rally and close near the highs? Let's take the close out, okay? I don't want you thinking that you have to know or be able to predict the closing price. That's more advanced. You don't even need that to be profitable. You just need to know, is this daily range more likely to expand higher or lower than the opening price? That's it. That's all you have to do. That's the key to bias. Now, how do you know what the bias is going to be most likely. Not everyday bias. Most likely, what's the bias going to be? Well, let's go back to this low over here. It creates a swing low. That means a low with a higher low to the right of it and a higher low to the left of it. So it's 3 candles that make up a swing low. You do not need a Williams fractal. That's way too many candles and you've missed the move. Okay, you don't need that. No disrespect to the gentleman, but that's nonsense. You don't need that. Okay, you only need 3 candles. Once you get a swing low or a swing high and you have the proper context and you know what you're looking for, that's it. You go in and you start hunting it. Now watch what happens. We have swing low form. The very next candle, we have an opening. It trades way down and then comes back up and closes right near the highs. Is that the opposite of this candle? Yeah, but it's got a whole lot of movement below the opening price. So something just took place down here after this swing low was formed. Did this candle or bar go lower than that one? No. I promise I'm going to switch the candles, but I just want to show you from this perspective because this is what we were forced to learn on back in the old days, okay? Back in the dinosaur time. So the rallying up on this candle here and closing on the high, that supports this as a swing low because it didn't take out the lower low right here in the middle. Between this low and this low, this is the lowest low of the 3 candles or price bars. The next day, we have a big washout from the opening, trading down, and then it closes on the high. So the next day, we're likely to go what? Into this area here. Isn't that a fair value gap? Sure it is. What's the daily bias likely to be? Bullish. So that means it's going to do the opposite of this. It's going to open near the low and then rally and expand higher. Will it close on the high? I don't know. It could, but I don't need it to. I only need it to open and start to rally and get up in this area here. That's an opportunity. That's a trade. Does it do it? Yes. But now when we trade it up into this area, look what happens. Next day, you might be expecting an open rally, close high. It doesn't give you that. So that could be a day where you missed an opportunity or you took a loss. No problem. Next trading day here, what are we seeing? We're seeing the market retrace back down into this run. How far can it go down? Well, look at your high down to your low. Equilibrium, it's probably going to go below equilibrium to do what? To offer the market a discount. The market does what? It goes down below it, provides a discount. Once it gets there, our mind, we're thinking it's going to be the opposite of this. It's going to be the open near the low and expand higher. That's power 3. It's going to be accumulation of longs at the low and then rally higher. We have it right there. It opens near the low, rallies, and closes on the high. The next day, same thing. Opens on the low, rallies, and closes on the high. Now we've gone deeper into this area here and in a small little range, but it's still the same function of power 3. Accumulation, which is open near the low, trade down, and then close high on the daily range. Next candle, same thing. It opens, trades down, accumulates longs, trades higher. Same thing here. What's this? It opens, trades down, trades higher. Until we do what? We take out this short-term high. See that? Then we can get a retracement lower or consolidation. We get both. Small little retracement and consolidation. Next candle, power 3 delivering for accumulation of longs. Next candle, consolidation. Might be a day you took a loss. Let's be real. Next candle, what's the bias? What are these over here? They're relative equal highs. There's stops resting above that. That's buy side liquidity. What's it drawing up to? We've already taken out this high. What's going to go up to here likely, right? Because we've already taken out sell stops below here with this drop, and we keep proving it's going higher. So where's it likely to go? Above here. So until we get to that point, we keep thinking the opposite of what we're showing here. An open near the low and close on the high. Power 3, accumulation of longs. Distribution of longs at the close. The next day, indecisive candle. Okay, no big deal. Next candle, we open, trade down. Same thing. We're looking for buys. The whole time we're looking for buys in here. You might get stopped out. You might have a losing trade, but you're not abandoning the bullish bias until we get above these highs. Then we have to study it. Does it want to run higher? Once it clears these highs, does it keep showing it want to go higher? Well, we had a nice run here. The next candle here, nice run here. Small little indecisive candle there, but then we go back in the same cycle again. It's expanding and it's accelerating higher. Each day, we're looking for longs. Opening near the low, trades below the opening a little bit, and then rallies and closes near the high. That's bias. That's sticking to your bias. And the same thing is done over here on the opposite. We have an imbalance here. And I promise after this, I'll change it to candlesticks. Your eyes are probably going nuts right now. Fair value gap, we trade up into it. So once we trade into it, what are we expecting? The market to do what? Trade back lower. So if we're trading back lower, we're going to be looking for this pattern. Open, rally, accumulation of shorts, distribution at the lows. What are they distributing? The short positions they've accumulated above or at the opening price. So in this candle, what do we have? We have the open, it rallies up to go short, and then trades down and closes on the low. Just like this is here. See that? The next candle, you're expecting the same thing. Does it deliver that? No. You might take a loss that day too. Okay, no big deal. It's likely to go where? Here's where the sell side is now. Each candle, open, rally, close down on the low. Open, rally, close down on the low. Open way back into this one. And then still closes lower than the open, but still nice range down. Same thing here. Opens, rallies, sells off. Next candle opens, sells off. Then comes back and overlaps it, and now we have a potential key reversal. Then we have back and forth price action where you can probably get beat up. Imbalance, it trades up into that. And then we go into that area where we're at now. So let's go to a candlestick, and it's a lot easier to see it this way. But this function of Power 3 is how I teach the bias, and I also teach how to submit to the daily range. You have to learn how to hold to the close. If you're going to just day trade and you're not really participating in the sustained moves that's made available in these daily ranges, like today, I mean, look at this move here. That's nice. Many of you probably took shorts. Maybe some of you took longs. I got some people putting comments in the previous video saying, you know, I saw a fair value gap at this price at this time for a bullish. It's not bullish. We're not buying. Our bias is not bullish. It's bearish. It's already traded to the top end of that fair value gap. And it's likely to go lower now, taking out this sell side and attacking the sell side over here. Okay. All right, let's drop down to an hourly chart. And that fair value gap, the high and the low levels, that's what's being shown here, right there. And these annotations are obviously from what you saw on the episode 9. So watch what happens. The market trades down, finds some support at the low end of the fair value gap, then rallies back up to the high end of the fair value gap, and then breaks right before midnight on the 17th. And then we consolidate, trade back up into what? What is this? What's this right here? It's the fair value gap. Price goes up, rebalances that there. And it's doing it what time of day? Not New York. It's overnight. European London session. That's just how you can use that model. The same model. You can use it in an Asian session. You ain't going to get a lot of movement because it's typically not a lot of movement in that time of day. But you can trade it in London close. You can trade it in, obviously, the New York Open, like I'm teaching you, and London Open. London Open, if you know what you're doing with the daily bias, you can catch enormous moves. But sometimes you're going to have to weigh out a lot of give and take back and forth, kind of like today, where the market rebalanced here and then consolidated and waited for a little bit of a push higher. Then the news came out. Okay, so I'm going to hopefully clear that up for you now. All right, 15-minute time frame. I'm going to take a look at this imbalance here. We rode up into that, rebalancing all this movement down. Remember that paint roller analogy I gave you? The paint was applied to the wall going down, but all this movement was given to that one single candle. There's going to be little porous places in prices between the high and the low where the market wasn't efficiently offered for buyers. There wasn't much time and back and forth pricing to give buyers an opportunity to get in there and participate. So an efficient market will see the market go back up and reprice that. So it's down and then right back up, like paint being applied to a roller on a wall. You want to make sure you go back and forth to deposit the paint evenly. So there's an even distribution. So again, the background of this chart, that's the wall. And every one of these candles is a paint roller. And whenever you see these big, long, drawn out candles, there's a strong tendency, not all the time, but there's a strong tendency for the price to go right back up and overlap over that entire range. Same thing over here. We have the market drop down, creates a fair value gap here. Doesn't it take out some lows over here? Yes. There's displacement. And then you can have an order to get in short here. But then watch what happens. This little pump up. That might be scary. It could have stopped you out and went higher. That's the risk in this, folks. I'm not going to give you a silver bullet that removes losing trades. I lose trades too. You're going to miss moves. I miss moves. Okay. You're going to read it wrong. I read it wrong sometimes. Okay. I'm not perfect, but I'm giving you tools and processes to help you determine where the most likely scenario is going to be. And then you just work those statistical odds, and hopefully with sound money management, which I'll cover, which will hopefully get you to the winner's circle more often than not. All right, so we have the morning session starting before 8:30. We have a rally up, and then it breaks lower. In this area here, we're going to drop down to a lower time frame. But before I do, I want to give you a little bit more details. Think about what I've taught you so far in this teaching for Power 3. The accumulation, manipulation, and distribution cycle of the daily range. If we are trading near the high end of that fair value gap on the daily chart, that's what that level is, okay? When we just drop down to a lower time frame chart. So with this 15-minute time frame chart, and I apologize, the chart's a little bit shifted. It's still the same chart, just added annotations. The idea is we're expecting this Power 3 formation where it's open, rally, create the high of the day, sell off, and close near the low. That's what we're looking for. Why would that bias be expected on this day? Because we worked the upper end of that fair value gap on the daily chart. Then we had multiple shifts in market structure bearishly when we already have a bearish bias on the daily chart anyway. So it gives you a high probability that this day is going to be a down close day. It may not close on the low. It might just be a big down move. And that's all you need. You just need movement. So this level here, it's dashed. That's the midnight New York opening price. This is what I'm referring to when I'm looking at the opening or Power 3 on a daily chart. That price right there at midnight. Look what's occurring. That right there is equivalent to this little tick on this diagram here. It opens, it trades above the opening, just like that candle does on a daily chart. It opens and goes higher. You want to be selling short here. Why would you want to go short here? Well, it went back up in there and redelivered the down stroke on that paintbrush or roller on the wall. Well, now it's going back up. When it's going up like that, it feels unnatural to go short. Like, you don't want to sell short. It's like, this thing's going up. Why would I want to go in there and go short? That's the benefit of studying old data and then reading price, studying it real time without taking any demo trades, without trying to pick the targets. Forget all that. You want to practice for months, reading the tape, studying price action, watching it. Even if you have to watch it with TradingView's market replay function, there's nothing inherently wrong with it. If that's all you have and you can't watch it live, but it is altogether something different and much more beneficial if you can watch the actual live data. So as I mentioned in my own paid mentorship, I always counsel my students to, if they have the means to do so, invest in like I have Camtasia. Camtasia is what I use to make these videos. It's through TechSmith, and TechSmith, you can Google them. It's pretty inexpensive. It's an easy platform to use. And I have had wonderful results with it. I don't have any complaints. I've done all the upgrades every time they have it. It's just really good. If you have a job, or if you have a business that you're running, or if you go to school, or if you just got to sleep, if the time zones don't line up for you, you can set up a recording and just let it record for 8 hours. It'll do it. And as long as you have space on your computer, it'll do it. And then you can go back and literally play that time, real time, and watch the candles paint. Unlike TradingView's replay function, where it doesn't give you the ebb and flow of the candlesticks forming. It's just basically the opening and then a closing of what the candle did. It's kind of clunky and wooden. It doesn't really give you that organic feel of the candlesticks actually forming real time. Whereas if you recorded your screen doing it, then there it is. Don't worry about your screen burn-in time either. Camtasia will record the screen. If your screen protector comes on and it goes blank, it'll still record the screen. All right, so we're looking at the opening price here, and then we're expecting a sell to form. Well, here's that fair value gap. It rallies up into that. Isn't that a sell above the opening price? Yep. Sure is. From that opening price to that high, that's the highest high. Take that range and subtract it from the opening price. That's about in this vicinity here. Okay, right in there. So what's occurring? Well, we have this sell here. Then we have this sell here at the equities opening. And then we have this imbalance in here. So from this range high to that low, multiply that by 2 as a projection. In other words, whatever that low is to that high, that much lower you'll expect to see a short. And it forms right here. That's exactly what I taught you. I did not cherry pick that, folks. You can go back and look at data as long as you can find data on daily charts, okay? And if you can get a intraday chart, like an hourly chart, you'll see it. It's there. But this is a 15-minute time frame. That's my bellwether chart. That's what I teach all my students. This is the one you go to for day trades and or scalps. You can find everything for intraday trading on a 15-minute time frame. If I was held to a decision of what time frame would you be forced to trade with if you had to pick just one ICT, the 15-minute time frame, because I can do anything with that 15-minute time frame. I can swing trade, I can short-term trade, I can day trade, I can scalp. But you only need to have one discipline, one way of doing it. And you might not like the 15-minute time frame. You might like the 1-minute chart if you're trading indices. But you have to have the storyline of the 15-minute time frame to get the full panoramic view of what price is likely to do. So with this continued teaching here, right below here, what's that? That's sell side liquidity, relative equal lows. So you can test this on your own chart. I omitted it by mistake. I apologize, but the low on this candle here is 14,381 even. Okay, don't take my word for it. Go look at your own chart. It's there. So 14,381. I would have preferred to include a line projecting that out in time, because you'll see in a moment when we drop down to the lower time frame. But the setups are forming here above the opening price, right here near the opening price. See that? And inside of the range from the high to the opening projected down, it's in that vicinity there. So it's giving you another opportunity. So again, what's occurred is we went up into that fair value gap on the daily chart. We're back on the daily chart again. And we're anticipating the opening and rallying up into what? Maybe the high end of that fair value gap, or something forming at the news release at 8:30. But if we look at price was starting to pump up higher ahead of the 8:30 news release. So what's that tipping its hand to you, telling you? They're pricing in a premium market ahead of the news. So they're going to use the news to sink it lower, because the bearish bias is going to come into fruition. They're going to expand price lower, and they've already established their shorts because they accumulated above the opening price. And we can see that in the price action of each little short-term rally up, like we're looking at here. So here's 7 o'clock in the morning. It rallies above these relative equal highs and cleans up the imbalance here. And look at that right there. See that? Remember I told you there's 2 fair value gaps? Try to trade it in here, but anticipate and use the money management to allow for your stock to weather a run up into that. And we got it right there. Now, strip it down to what I taught you for the structure of the trade, or the framework. Swing high, broken to the upside, taking down buy stops. So buy side liquidity is taken. Then we have a swing low. It's broken. Did these candles come down lethargically? Was it like a slow meander decline? No. It was sudden. It was a lot of momentum. It was energetic. You can't miss those down close candles right there. That's obvious. They stand out, right? So that's how you know you have a shift in market structure. In this area here, it doesn't have a fair value gap. That's okay. This is only a 5-minute chart. This is where we start doing a top-down strip of 5-minute, 4-minute, 3 minute, 2 minute, 1 minute. The first fair value gap we come to, if we find one on a 4 minute, you don't need to go down to a 3. You don't need to go down to a 2. You don't need to go down to a 1. If you go down to a 4, you don't see one, you go down to a 3. If you find one there, you don't go any lower. Okay? If you don't find one on the 5, the 4, or the 3, and you go down to the 2 minute, and you find it there, that's it. You don't go down to the 1 minute. If you don't find it on the 2 minute, and you do find it on the 1 minute, then that's how you trade it. But what if you don't have one on the 1 minute chart? You don't have a trade. How's that for logic? So we have the continuation lower off of a retracement in here. Now this candle, the high of it, here, I wish I would have used a lighter color, but this candle's high is right there, okay? It actually goes just above that one right there. Not by much, but it does. But we don't need that. We don't need that. Watch what happens. Here's the 4 minute chart. Uh-oh. Something different on this chart, ain't it? We have buy side liquidity here. The candles are a little bit more beefier when we were looking at the previous slide. Look at this one. Look at the candles. They look wonky, don't they? But on this time frame, they become much more prominent, more beefy, much more stout. Like, look at me, I'm here. Take a look at me. That's what we're looking for. We're looking for clean price action, where we can see the nice candlestick formations, where we're seeing the even distribution of the price going higher or lower, in this case going lower, but we're seeing that little break where there's not an even distribution of price. That's the fair value gap. So we have that run above buy side liquidity. After rebalancing over here, it goes above it and it breaks down. So we have an idea, okay? We could potentially see a trade short here. I like this fair value gap, but we also have a little bit of imbalance in here. So I want to trade in here, but my money management has to permit me to weather a run up into this area too. Remember that, that's part of the rules. But in here, we're going a little bit deeper. In my YouTube channel, I teach a breaker pattern, okay? And that is a high, a low, and a higher high. That's what this pattern is here, and we're seeing that return here. So if I see a breaker like this, yes, I think the market could potentially trade up into here, but I'm going to use the breaker's candle and just above that for my stop. So I'm not going to go way up here or way up in here, because my foundation to teaching the ICT breaker is the market's going to mostly stay in the lower half of the breaker candle, which is the down close candle right for the big move, up higher, taking out a short-term high. Trust me, the breaker is taught in the YouTube channel in other lessons. I'm not going to pour myself over top of lessons and regurgitate things, because there's a lot of you that have been training with me for a long time, and you don't want to go through that. And the new people that are here, I understand your enthusiasm and you want to know everything like a sponge. I get it and I love it. But trust me when I tell you, that is taught in the free lessons in this YouTube channel. Okay, just remember it's a bearish breaker, and that pattern is the support structure of why I would not expect it to have a higher stop up here. Okay, so here's the fair value gap range from the low and the high end, but it's specifically this candle's low and this candle's high right there. Extend that out in time. Look what happens at 8:28. The candle's showing 8:28 here because it's a 4 minute chart. But once we're trading inside here, all I need to do is trade above this candle's high. I want to be short. I don't want to mess around. It might not give me an opportunity to get in. It might not go higher up into that fair value gap. I want to use the easiest, lowest threshold entry technique to get in to make sure I'm a part of the move. Then I'm going to be aiming for those relative equal lows. That's that 14381 level, 14,381. Remember that relative equal lows? I said I wish I would have put a line on it. This is the time when I added the line. It's the 4 minute chart. Now, if you look real close, you can see there's a little tiny little arrow right there and a bunch of them over here. What that is TradingView's paper trading module, and I put some short on this today to illustrate what many of you have been asking me in TradingView comment section. A lot of you send me comments through TradingView, and I apologize. I don't get to them a lot because there's a lot of them usually that happen, and I just don't get to them. I'm sorry. I'm not purposely trying to ignore you. It's like Telegram. Telegram, people send me messages there too, and I don't have time to go through it. Emails, absolutely. I don't have a whole lot of time to get through because everybody wants to write a long story to me, and I appreciate them, but I can't sit there all day long and read all that. But the idea of showing what a discount broker margin, what could I do with that? Okay, I don't recommend it, but there are brokers out there that will allow you to trade the mini contract for just a couple $1,000s, and the micro for less than $100. And to me, that is absolutely stupid. You're asking to blow the account. In these markets, you absolutely can have your hinder parts handed to you in short, sudden fashion. Even me, in the last, I don't know, 4 weeks or so, I've seen moves that came back on my stop so fast. I was like, wow. Just the other day, I watched a 100-point run come out of nowhere in a 1-minute candle. It moved 100 points in the NASDAQ. 1 minute. That's a lot of movement, man. So if you're looking at that and you're trying to hold, let's say, I don't know, 16 minis or 8 minis, and it moves $2,000 against you in 1 minute, folks, your stop would not have been respected. It was literally way above your stop loss if you were using one. Okay. So you would have got stopped out with negative slippage. And let's say you were holding those 8 contracts. Well, let's say you got burned for 50 points in slippage and you don't think that's possible. Oh, it's there. 50 points, just like this. That's $1,000 times your 8 contracts. You just lost $8,000. And you're going to tell me that you can open up an account with I don't know, $10,000, whatever, and you're going to trade multiple minis because the discount broker allows you to. And all of a sudden, you just roasted your account in one trade in some wild little price move that came out of nowhere that you didn't expect. And in one candle, 1 minute candle, it just smoked your account just like that. There's teachers out there that are promoting the idea that that's a good idea. It's not a good idea, folks. $10,000, that's the absolute minimum. And I don't think it should be that. I think it should be a little bit higher than that. I think 15,000 is fair for what the NASDAQ is doing right now, because just today alone moved 8,000 per one single contract, and over $8,000 in movement for one contract. Now that's, top to bottom, and the likelihood of you being in that move is probably, obviously not likely, but the measure of risk needs to be appreciated and respected. And unfortunately, YouTube makes it available for anybody to come out here and pretend to know what they're doing. And unfortunately, if that person isn't skilled, if they don't really do what they say they do, or teach proper risk, or to teach you to respect the level of risk that's required to trade these markets, they're doing you a disservice. And that's the number one reason why I taught for a long time with a demo and still teach with a demo, because number one, legal reasons. I'm not trying to be held liable because I'm not licensed to get trade advice, but it's not trade advice in a demo account. You're not making or losing anything. It's fantasy football with price charts, but you can learn how to read price action with it. This year, I've been showing you a live account. That's real. I'm not teaching through that. Notice that? Okay. At the end of the year, I'm going to share with you what that account has done. I'll be 100% transparent. I will show you line by line every single trade from every single trading day of every single trading week of every month. You'll see it. Okay. Throughout the year, I'm going to be teaching lessons about certain things, and you're going to see them applied when I share the entire history with that account. So it's more meaningful, because there's a lot of you in the comment sections that are trolling, and I know what you're here for, but I'm going to give you undeniable proof, just like the rest of you. That way you can see the lessons I'm giving you. Yes, they worked in demo. but they're actually being utilized in live fund trading by me. It's after the fact, so I cannot be accused of giving you trade advice. It's what I did with my real money. See the difference there? It is what it is. If you don't like this teaching style, there's other people out there teaching all kinds of great stuff. Doesn't mean it's profitable, but they got all kinds of neat stuff to look at. I'm teaching you how to read price. And I need you to be sober-minded about the level of risk that these markets provide us, because it can take you out quickly. So I got questioned by, I don't know, 6 or 7 of the people. Some of them are actually my students in the mentorship, and others are just people that are on the internet. I don't know if they're just YouTube or if they're just TradingView, people that try to follow me on there. But they asked, could I showcase what I would do with a $10,000 hypothetical account if I was using a discount broker? In other words, a broker that would let me trade with, I don't know, like $2,000 or $1,500 per contract, something to that effect, for a NASDAQ mini contract. Number one, it was crazy trying to find some of those setups, because to frame the risk in it and to do big lot sizes too was very challenging. But I kept it low end. It only took me 2 weeks to do this, but you can see I put a heavy-handed short up here using what I'm teaching you here, and then aiming for those relative equal lows, which is that 14,381 level. This is my TradingView account. Now, you're going to hear people say, this is photoshopped. Oh, you photoshopped this. No, I did not. I don't need to Photoshop this. In fact, my live mentorship with real students that paid me, they're going to see me show this live, and it's going to move all around. It's not edited. I'm going to log out of the account and log back in, so it's not me doing any kind of editing. It's not MT4 servers or anything like that. You can play around with it. It's not NinjaTrader where you can go in there and take a bad trade out, make it look good. All these things here are executions. Okay, and you can see there's 3 losing trades there on the 14th. And you can see today's trades all up at the top. And that was me doing a heavy-handed, quant style, heavy-handed short, and then taking partials as it was going down into that level of 14,381. Looking at this, this is your classic, the guy shows you the results, okay, shows you this is what I did with my demo account, and they may lie and say it's a real account. This is clearly a paper trading account. You can see it, it's there, it says it right up here, paper trading, okay? Paper trading. This is all paper money, okay? I started the account with TradingView at $10,000, okay? And that was on February 3rd, just 2 weeks ago, to the day, okay? So 2 Thursdays ago, I started this and set the account to start with $10,000. Then I started trading it, and you can see the positions here with just the NASDAQ, okay? I'm not doing anything with like forex to make it go up. I'm not trying to pull out bonds. I'm not trying to do anything like that. I'm showing you just the NASDAQ. Starting with $10,000 in 2 weeks, using, again, the limitations of, well, I don't want to say limitations, the pseudo benefit of a discount broker. What could I do in 2 weeks doing that? And using what I'm teaching you too. That's the difference. I'm literally teaching what I'm showing here. I just showed you the example of it in the chart before. This is the equivalent of 582% in 2 weeks. Now, it's hypothetically done in paper trading, yes, but with the perspective of a hypothetical discount broker margin being used. So whereas I'm trading with TD Ameritrade right now, and they require me to have almost $22,000 to trade one contract, I don't have a problem with that because of the level of volatility that's in there. It just makes it easy for me not to worry about it. Like, I'm not worried about it. I know I got plenty of margin. I know I got plenty of equity. If I get banged by something come out of nowhere, say Russia goes into Ukraine or China invades Taiwan or something crazy comes out and it crosses the market to go nuts, because I expect that to be coming anytime now, it won't smoke my account. Okay, I'm not gonna blow the account. I guarantee you this account's not blowing. Okay. And I'm showing, in my opinion, what it would be like for someone if they ever got to the point where they put years into developing their own model. Now, that doesn't mean you can't find profitability before that, but after you've done it for a while and you found your own niche of what you want to do with the content I'm teaching you, you'll find your own groove. And once that's done and you can formulate a well-written model on paper where everything is outlined, when do you buy? When do you sell? Where do you put your stop at? When do you move your stop? How many contracts do you trade? What constitutes a day where you don't take a trade? All those types of things. I will teach you those lessons in this YouTube mentorship. Okay. A lot of you also are very, very excited and you're like, okay, I see you doing this, but I'm not really learning anything new. I'm disappointed. I'm not done. You give me those complaints after I say I'm done. Okay. But I'm giving you gold. Like, this is something that you can go out there and turn in these markets and really develop a skill set that could completely change your whole entire direction in your life. I'm not promising profitability. Notice that? See that? I'm not promising that. I'm not promising you a 6-figure income every year. I'm not doing that either. I'm telling you that you will love price action because it repeats. It's something that's, well, it repeats. And if you know something's going to repeat, it's familiar. And things that are familiar are comfortable. Right now, you don't know what these patterns are likely to do. They're unfamiliar to you. So it's important for you to understand that that's a temporary struggling point. But going through the things I'm going to teach you to do here, and I'm streamlining it. Yes, this doesn't feel like streamlining to some of you. You want me to come out here and say, this is where you buy, this is where you sell. You just put your stop loss right here, and this is where you take your profits. And it's always like this every single time. Wash, rinse, repeat, and it never violates any of those rules. And it's just always the same way. If you think that way, just change this channel right now. Don't even come back here, because that's not reality. There's going to be similarities that look slightly different than the last few times you took the trade, but you will recognize them. But my question to you is, if you could do this over a year, not 2 weeks, would you be impressed with yourself if you could do that? Would you feel that it would be enough? Some of you young guys don't think that this is enough. And it's amazing. That type of return is amazing. If you can turn that with a live account, that's phenomenal. Like, that's wealth making there. You don't need to be that high to make money. But if you can hit that kind of number a year, over 12 months, hit something like that, that's amazing. And that's not even what I teach my students to expect. And this is not bragging. I'm not trying to say, look at me, I can trade a demo account. Look at me. That's not what I'm doing here, folks. Okay. I was asked sincerely to show. You all hear me telling you, and I'm showing you, it's a paper trading account, because I'm not going to go into AMP or some other broker that's going to allow me to trade with discount broker margins. I'm not going to do it. I know, even what I know, I'm going to get smoked if I try to do something crazy and heavy-handed, because even with me trading one contract, I've had moves come against me pretty sudden, and there was nothing I could have done about it because the volatility is so fierce right now. I'm not afraid of it, but I do absolutely respect it. So to provide a answer to the guys out there that say that, yeah, it's stupid to trade in another account where they use the exchange rate margins for initial margins, which is right now almost $22,000 for the NASDAQ. One mini contract, you need about $22,000. It was about $17,160 about 3.5 weeks ago, 4 weeks ago, but they raised it up. If they raise the margins, listen, this is for your notes, okay? If they raise the margins, that's the exchange tipping their hand to you that huge moves are coming. Big, monstrous moves are coming. And they just raised the margins. You think that's coincidence? It's not. Big moves are coming. And if you're offside, it's going to get real hot in the underpants. But if you're on side, Oh man, there ain't nothing sweeter than that. That's like winning the lottery. And these moves are significant. I mean, let's go back up for a second, okay? And I'll close this video. If you look at the fair value gap in here, okay, and say you're filled at 14,515, and you're aiming for 14,381, is that 6.5 points? No. Is it 20? No. Is it 50? Mm-mm. Is it 100? Nope. It's more. Do you see a pattern here? One contract? Folks, what I'm teaching you is literally a ATM machine in your hands. I'm giving you the PIN numbers. Every time I do a video here, I'm giving you another digit. And once you figure out what it is that you want to do with this content and make it part of you, and you'll see what I mean by that. Right now, you might see me showing you. It's like, man, this makes perfect sense. Most of the comments that I don't allow to be posted are just sugar, sweet, diabetic coma type lovey-dovey comments. And I'm not making fun of that. And I appreciate it. I know what you mean by it. And you want to show your adoration and respect. And I love that. But don't lose sight that you're feeling that splash over because I'm literally taking you into the chart and showing you what I know. And you're excited because you know the opportunity is available to you if you stick to this. And that's the right perspective. But don't lose sight and think that, oh, I just watched that video and I'm going to go out there and trade, because I've had some people post in the comment section and they try to do something with live accounts, which I already said, no, don't do that. And they're saying, I don't think these concepts work because I tried to do this and I tried to buy this fair value gap today. And you know who you are. And I'm not trying to make fun of you. I'm not talking down to you. But the bias is bearish. So if the bias is bearish, would you go in looking for a bullish fair value gap? No. That's the purpose of having a model. And then with that model, each morning, before the markets even start trading, you write down what your intentions are. What does that mean? I gave you the range, right? Here's the opening price. It rallies up to that. So inside that range, you're going to look for a setup. Go short. You're bearish. And if it goes down below that low, you can still take a short if it's in this range minus this low. Okay. If it leaves that area, you can't chase it. I don't care how good it looks later in the day. You don't do it. You have to have discipline, folks. If you don't have discipline, your broker's not going to help you with that. They want you to click that button so they make money. And they don't care if you blow your account, because there's going to be 20 more to replace you, because they've watched the ICT videos. They've watched everybody else on YouTube that try to tell you that you can do this. And it's so easy. Even a pizza delivery boy can do it. So hopefully this has helped clear up the idea of bias and power 3. And I will be repeating these themes when it's applicable in the newer videos that come out and examples I'm going to teach with. But for now, I can't say it enough. What you were just exposed to, that is the underpinnings of what we do in my camp, okay, ITT. My students, we look at price like that. Let me throw one more thing in here just to piss off everybody that doesn't like these long videos. Let me go back up into this area real quick. And on a daily chart with the candlesticks, that's what I'm looking for here. Here we go. All right. Notice something. From this low up to this high, it's bullish. Okay. We're expecting bullish prices. This is how you backtest. You tell yourself in your annotations, I was expecting. You're basically lying to yourself in the comments of your chart when you're backtesting. It sounds foolish. Okay. Trolls are going to love that comment coming out of my mouth. But what you're doing is you're teaching yourself pseudo experience. It's training your subconscious to see this stuff like you saw it live. And when you record it on the chart in your own annotations and you log it and you keep it in your journal, and on the weekends, you go back and look at your Monday, Tuesday, Wednesday, Thursday, Friday, and then you look at the previous week. And you start looking at these patterns and how it repeats over and over again. When it's bullish, you're trying to stay with the opposite of this. open near the low, close near the high, but expansion to the upside. So accumulate longs, manipulate, get people thinking it's going to go lower, and then ram it up higher. Distribute the longs near the close. That's what you're looking for here. With that mindset, okay, you're all afraid of, but what happens if it's a down day? ICT, what happens? Well, the worst thing that can happen is you lose money. And if you think that you're going to trade and not ever lose money, turn the videos off. Don't ever watch anybody else's either, because that's not a proper mindset. Traders are professional losers. They're managing every trade right from the beginning. They got to come out of the costs. You're paying a commission. If you got slipped in forex, you got a spread. Every trade opens up as a loser. So a trader is a professional management company of losing trades. They turn losers into winners. But not every loser can be turned into a winner. But they don't lose their business because a few never become winners. It's real important to understand that, folks. It's a paradigm shift that took place when I was a younger man. I felt that there was a way for me to always win. I was convinced of it. There isn't. There is no way of doing that, okay? So last analogy, last lesson, and the video is over. If we're bullish here, okay, we're expecting each candle to expand higher. So in other words, the close be higher than the opening on each individual candle. My up candles are green. How many black or down close candles do you see in this price run? 2. Wow. How about this price move here? It's going lower, right? Going down for the sell side here. You're bearish. But what happens, ICT, if it goes up? You'll probably lose money. But let's count how many up close candles we have. 1, 2, 3, 4, 5. Look how much range it moved. If you can't have a model that weathers, say you got a losing trade each one of those days, if that blows your account, you're not managing your risk properly. You're over leveraging or over trading. See how easy that is to deduce your problems? It's simple stuff, folks, but you're scaring yourself. You're overthinking things. You're listening to me talk about multiple concepts that will come together in a few weeks, but you're overthinking everything. And you're trying to assume just because you watched a few videos and you're thinking foolishly that just by watching a few of these videos, we're only in episode 10. 10 episodes. And some of you think you can go out there and own the world now. I understand it's empowering information if you've never been introduced to it, but you're not going to own the world up to episode 10. Okay, you're not going to do that. You're going to lose money if you go out there and try to do this stuff. There's a lot of things we still have to cover. And you haven't even back tested enough. I haven't even been teaching it long enough on YouTube for you to even have a backlog of data to draw experience from. So think about that, okay? Trust me when I tell you, folks, these moves repeat all the time. All the time. And don't feel like you're missing out because you're not doing it right now. Put that feeling aside. Make this fun while you're learning it, and it'll never feel like a job or a tedious task. That's going to be it for this one. Hopefully it was insightful to you, and I'll talk to you next Tuesday. Enjoy your weekend and be safe. All right, folks, welcome back. A little bit earlier broadcast today. I have some plans this evening, so I want to get it out of the way. All right, so we're looking at, obviously, a hindsight view of something I pointed to before it happened. So that way you guys got a chance to see what it was like for my private mentorship group. When I say these things, it's almost like an invitation for some of you to email me to ask to join that. You can't join it, okay? I'm teaching mentorship on YouTube, okay? So that way you don't need to reach out to me, okay? I'm teaching right here. And you didn't have to send me any credit card information. You didn't have to set up any kind of PayPal account. There's nothing to worry about. You either watch it and enjoy it and get something from it, or you never come back and watch it anymore. Okay, it's very simple. But I'm getting a lot of feedback from the comments, and it's been very positive, so I thank you for that. It's very encouraging. All right, so we're looking at the E-mini NASDAQ futures contract for the March delivery. And if you remember, I was outlining this imbalance in here. Okay, and I gave you the high of this candle, the low of that candle, which it should be sitting right on that. So with this imbalance, we traded down to a discount, back up to a premium. Again, measure the high to the low, and I'll do that for you now. So there's some of you like, can you just do it for me? All right, so here's 50%. That's equilibrium inside this dealing range high and low. So we traded from these lows up into a premium above 50%. Below 50% as a discount. Here we tried to rally up above this high, failed, broke back down below 50%, and created a gap. Okay, so it comes up back into a premium market above 50% and fills in the gap. I mentioned how this type of retracement can lull traders into likely thinking it's going to go higher, but we're thinking down here. Okay, the liquidity resting below here is what they're going to attack. So all of this consolidation just sets up another selling opportunity to run down there. And again, you're welcome to go back and listen to the previous discussions, and you'll hear me basically say that we're going down here. All right, so it needs to rebalance this first, and it spends 3 days in that range. Notice that? Then it releases to the downside, attacks the sell side here, and trades into the sell side liquidity resting below here. So let's go into a lower time frame hourly chart and figure out some more information and details. All right, so here is the hourly chart. You can see that high end of the fair value gap and the low end of the fair value gap. We traded up into that, sold off, consolidated, sold off once more. And you watch me share on the community tab my live trades from yesterday. It was traded through TD Ameritrade. It was not a demo account. Okay, so I'm going to go into what I used, what I saw, and then obviously I'll show you in the account where the details were. Okay. All right, so the market started trading, rallied up, took out a short-term high on Friday. See that? Then started the breakdown. Now, overnight, I was watching this, but I was hoping that it didn't take out that low before the morning. I wanted to see it trade up there, take that high out, and then consolidate after running below that short-term low. I didn't want it to be in a hurry before the New York session in the morning, because that would have set up a nice short up here where I could have taken a run under this low and then see if I can capture a re-entry, which is the entry you'll actually see me do, and then the drop down in here. Now, on Monday, it was a bank holiday, and trading stops at 1 o'clock in the afternoon on holidays generally, and then resumes around 6 o'clock in the afternoon New York time. And when we stopped here, we had already moved aggressively lower and stopped right there. So I felt very strongly that we were going to gap down below it, and it gave just a beautiful gap lower and run immediately. But I was looking at the 13,590, 13,586 level real time, and I couldn't get to my screen fast enough to close it out there. And I didn't want to put a limit order in, because if it got really far down below it and started running really lower with a lot of speed and such, I didn't want to limit my profitable exit with having a limit order in. So I just left it open-ended, and I wanted to see how far it would reach down in there. By the time I closed the trade, it closed me at 13,612 and a quarter. So my entry was 13,858 and a quarter. The exit was 13,612 and a quarter. That's not a little bit of ticks. Okay, 240 some plus handles. So you take that 240 some, times that by 4. There's your tick value for those that like to keep counting that. You're going to drop down into a 15-minute time frame. All right, so we had that run on Friday's high here. Started the breakdown, and at 10:30 in the morning, 10:33 was the actual fill. So it's right in that candle, right in here. I'm trading in that candle going short. So we're going to go into the details and look at why that was the case. And again, you'll see the live account log in the business. Okay, so just hold on to your horses if that's the attitude you have right now. Oh, you in hindsight. So we're going to go into a 5-minute chart, start going down into the details here. Make this a little bit taller so that way you can appreciate the imbalances that are being shown. All right, so we had this rally up, which in my mind was acting like a Judas swing in the morning. Okay, so here's 8:30. It starts to run higher. So I want to be in going short at this candle's opening. And you can see that, well, maybe you can't see it. The opening price over here, okay? Here is 8:30's candle right there. The opening at 13,798.5. So I want to be preferably going short something above that price. Okay, so I'm anticipating further weakness. And before I get any further in this one, I got several people, probably about half a dozen or so, mentioning their confusion with why I mentioned the opening price at New York at midnight and then the opening price at 8:30 in the morning. There's two reference points being specifically dealt with there. If you're looking at the entire daily range, you're going to use the opening price at midnight. But if you're going to be looking at the morning session, you're going to be looking at the 8:30 in the morning opening price. Okay, so hopefully that's made a distinction there. Don't worry, I have a market structured lesson coming up on Thursday that will further solidify and remove all doubts and concerns about that, okay? But for now, let's just go through this one. So 8:30 in the morning, that opening price, I'm bearish. I'm thinking we're going to go down below that green level there. That's the old daily low. So on this candle here at 8:30, I'm expecting all this being a fake rally. It's something to lull in traders to chase it going higher. The retracement, people that don't really understand order blocks, they're going to say, look at that, it's a down closed candle. I'm going to buy that. And then when it starts to go up like that, they feel, wow, this is really easy. Every down closed candle after a run up is a bullish order block. It's not. In here is the real context. Okay, we have an imbalance there. And that's what I'm looking at. I'm looking at this imbalance right there. So I'm trying to operate inside that range for a short. Now, I know because of the volatility, it can color outside the lines, and it's okay. The bodies of the candles are kind of supporting the idea of what I'm looking for, but the wicks I could care less about because I want to get in when it's ideal. And I'm going to show you what that was looking like for me at the time. So we're going to drop down into a 4-minute chart. Okay, so here is that imbalance and fair value gap on the 5-minute chart, but now it's a little skewed because it takes up 2 candles to show that range. The market trades up, and right in that candle, that one right there, that's where I'm going short. I got in at 10:33. Okay, that was my short. Dropping down into a 3-minute chart. Okay, the market trades up, works inside that imbalance, and right there, 10:33, that candle, when it's starting to bump up against the top end of that fair value gap, right there, as it hits that and starts to move away, I'm in there. I'm going short right there. The reason why I'm trusting that and not thinking it's going to go higher is because we have this high here, okay? And then we have this high here. Which high is higher? This one or that one? Obviously this one. Now, this candle's high. Watch what happens. From this high, we have a short-term swing high next to it here, and then we have one here. So this one makes a intermediate term high. So we have a long-term intraday on a 3-minute chart, which sounds like an oxymoron, I know, but long-term high, intermediate term high, because this high is lower than that one. But we have a swing high here and here that are lower, both being lower than this one. Then we have the same context right here. We have a high with a lower high on either side of it. So I have market structure behind me showing that this is, number one, it's a bearish market because my draw on liquidity is down here. It hasn't traded down there yet. Okay, so it's going to act like a big magnet. So all these fluctuations in here, without understanding what I'm showing you, it's going to feel like it's just noise. It's chop. It's not. It's actually telling you exactly what it's going to do. So the swing high here is an intermediate term swing high. So I will be going short real close to this high because it's likely to break like it does here. So at 1033, when it hits the upper end of that fair value gap, I have it now at this moment, go back one candle. We have this high, a higher high, and a lower high. So we have a high with a lower high on either side of it. That's a swing high. That is lower than this one. That is lower than that one. So it's far more than just, oh, he's just looking at lower lows, lower highs. That's what a myopic individual would come and watch this. So like when they see me put a rectangle on the chart, they're saying, oh, it's supply and demand. It's not. There's so many more factors involved that it's just not even in the same vicinity. Okay. So sparing all that, compare and contrast, because I've done a lot of that already on the videos on this YouTube channel. The elements of intermediate term, short term highs, I learned that from Larry Williams. Okay. That mode of deciphering market structure, he taught that in a video course that I bought back in the early 90s. And it was a video course that I mentioned many times in this YouTube channel, the Future Millionaires Confidential Trading course, something to that effect. It was 4 VHS tapes. And when he talked about market structure, it kind of went over my head the first few times listening to it. Like I didn't really understand what he was showing until I started really going into charts and saying, okay, here's a swing high. And this is how you learn it. Okay. Because trust me, watching this video or watching someone else parrot what I say and then say, wow, he did it in 5 minutes, he's teaching it better. That's not, it's not jealousy me saying that. I'm telling you, you have no idea what you're doing. You're not even teaching it correctly. And those that believe that they're learning it correctly are going out there and are wrecking themselves. What they're looking at is a price chart with a directional bias, okay? Something that's leading to a draw on liquidity. So I've already told you last week that we were going to go below that green line. That's where we were heading. So what you're doing is you're looking at all the swing highs. And every time you see a swing high, and a swing high is simply a high that has a lower high candle to the left of it and a lower high candle to the right of it. And the one in the middle, that's your swing high. Note that. Okay, in the old days, when we printed out our charts and such, and we had chart books delivered to us, we would get them once a week. They would give us the Friday's closing data and all the daily candles. And then until we got our new updated chart book, we had to hand draw in the open, high, low, and close on the charts, on the markets that we were following. So whenever we saw a swing high or swing low, we would just put a little ring above it, little circle, okay, like a little halo. And that would be a short-term high. Now, I would do a double circle or double halo for an intermediate term high, and then 3 halos for a long-term swing high. So that way, when I'm looking at price, it allows me to classify the level of high that it is forming. So it's not just lower low, lower high. No, you got to look at the nesting effect of the highs and lows. And again, that concept I learned from Larry Williams in the early 90s. He talks a little bit about it in his book, How I Made $1 Million Trading Commodities Last Year, which I believe is absolutely still essential reading, even though there's a lot of things in that book I think is just fluff and just like all the moon phases and things. I'm not into all that stuff. But his chapters on market structure and his $1 million trading concepts, those ideas and that premise behind it, they are still true today, and they probably will always be true. So if you don't have that book, my recommendation is to get it. Go and get it wherever you can. I'm not going to put any kind of affiliate links up so that way you can't think I'm making any money by shilling his books. I just think it's a really good book. And at least once a year, I go through it and read it just for nostalgia reasons. But I've got it pretty much remembered verbatim. But by looking at that relationship of the highs, I trusted this because we had a swing high here already in effect. And I know that this candle here is not likely to go above this one because this one didn't go above that one and this one didn't go above that one. Not because it's lower lows and lower highs. There's much more going on underneath the surface than just lower lows and lower highs. That's just, it's cringy when you hear people talk like that and they try to reduce it down to something like that, or it's a support resistance idea. It's just buy the floor and sell the ceiling. Okay. Or why doesn't ICT look at this trade over here and this trade? Because those trades are being referred to in hindsight by those people that talk like that. I'm literally taking live trades. I'm taking them, I'm executing on them, and I know why I'm doing it. I'm not guessing. I'm not trying to figure out or deciphering what it is after I get in a trade. I know what I'm looking for, and I know why I'm waiting for it. That is something that you learn by developing patience and trusting a model. The only way you trust it is to go through back testing. Look at all these price action moves and start classifying the swing highs and swing lows. I will amplify what I just talked about here on Thursday's lesson, okay? Because Thursday's lesson is going to be on market structure, okay? I'm going to teach a lot of people out there that think they know market structure. They don't really know that much at all, actually. But if this is the candle I'm trying to get in at and I execute on with all the understanding I just outlined there, I want to see displacement. We get it here. Now, if I didn't take this trade here, I could trade with the return back to this right here. Why? Why is that possible? We have a swing high. It's broken to the upside. This low is taken out here. This candle's high here. If it touches that again, I can be short there. Just using the imbalance in the fair value gap entry technique I'm teaching you. So I can go there and get short, or I want to get up here as close as I can to that important high that I've already outlined here. So I want to be in that and wait for that initial move. Because then when this occurs, when you're that high up in the session high. So at 8:30, right there, this run up, I'm real close to this high by entering there. Notice that? I'm not waiting for a breakout below that low. So I'm getting up in there where it's an optimal entry. I don't need to get the highest high. You don't need to get the highest high, but you need to understand why it should be trading away from the levels you're trying to enter at. And that's kind of like what I'm showing you here. I'm hinting at a deeper lesson I'll give you on Thursday. But the displacement comes, which is what I was waiting for, and it gives you a confirmation. When this occurs, it's just almost like, okay, just sit back and just relax and just let it do its thing. Now, Monday, again, was a holiday. So I knew I had abbreviated session hours. So I was going to close at 1 o'clock. So that's right in here. And then the next candle obviously would be 1 o'clock, and it's not trading. So it closed. But it closed here. I had up 1 o'clock, and then the holiday session closing at 1 p.m. in New York local time. And the low, that green level there. Remember, go back to the daily chart at the beginning of the video and what we were referring to last week. The liquidity, the sell stops below this green line. That's where it was going to attack. Okay. And it came in and did so. It opened up 6 o'clock in New York time, opened up and slammed down, accelerating lower. That is the move that you want to see. Being short up here and covering down below here. Once it does that and it runs into low deep, that's it. You take your profits and move to the sidelines and then wait, because you have a big gap here. It's likely to come back and rebalance that and fill it in. And it does. And then ultimately trades around that old low. And then it pumps up into the afternoon. Consolidates. Then goes into the early morning, afternoon hours. Right there. And I showed how this set up, because after a big move, you don't want to trade in the morning session. Just don't do it. And I purposely go into a demo account to appease that desire to want to trade. So I don't burn the account. I don't take the heat off of a nice win and replace it or dampen it by taking a losing trade. In my history, in the last 30 years, I've been fortunate enough to know how I have hurt myself. Those things are the things that I like to mentor with, but those are also the lessons that everybody complains about until they lose money, and then they come back to me and they're like, I wish I would have listened. So I get it. Everybody has their own interpretation of what they should be doing, how they should be learning it, but I've lived it. You're just now learning about it. So when I had a nice winning day, as you'll see, it was a nice little win. I'm not in a hurry to go back in. And then you have these days here where it can trip you up. You don't know what's going on. You don't know what's likely to occur. So I went in and I demo traded and used, again, quote unquote, discount broker leverage to compare and contrast those fellows out there that like to work in their market replay and paper trade their stuff with NinjaTrader, and then compare and contrast what I'm doing with TradingView. So it kind of like scratches an itch, and it keeps me out of trouble with a live account, because if you catch a good lick in the marketplace and you had winning trades, or you caught a really nice winning trade that you had to wait for to set up to pan out, when that occurs, if you're new, you have an impulsive tendency to want to go back in immediately and get that dopamine hit again. I did something right. I made money. When I was a younger man, I did that, and I had some really nice run-ups in the account, and then, boom, I get a really big winning trade. And all of a sudden, I feel like it wasn't enough, because I was solo. Nobody around me was supporting me. I had no support structure around me, none. I didn't have anybody saying, hey, what you do is awesome. You don't need to worry about it anymore. So it was just me saying I had to do more. So one of the mental hurdles you're going to have to contend with is knowing when enough is enough. And when you've made money, real money, in a live account, you just won't want to rush to get back in there again. You get folks out there that sit on social media and say, you got to push your edge. No, you don't want to push your edge, because if you keep pushing your edge, you're going to dull it. You sharpen it by knowing when to get in and when to get out, and you don't dull your edge. Okay, so when I hear people talk like that, I already know they're not profitable. I know they're not profitable because they're gamblers and they want to sound like they're doing something all the time, and they're not. And if they are, they're doing it probably unprofitably. So this morning, after 9:30, again, what's the bias? Bearish. That has not changed. Even though we had this run up, it hasn't changed. So at 9:30, equities open. After consolidation, it runs up, creates a high, and then runs up again, takes out the high. That right there is your run on stops. Wait to see if it wants to break down. It does. So we're going to look at that and refer back to the video. I just put a little short video up this morning and outline the whole business. And I don't want to do it here because it's just rehashing what I already showed in a very short 1 minute or so video. But ultimately, right in here, we have a nice little selling opportunity, and you can attack the fair value gap in here between the low and the high. Right there it would be. And if you want to trade with the longer term bias, you can attack the sell side liquidity resting below here and here, because they're relative equal lows. And then you would have got a nice fill there as well. So I teach in a manner that allows my students to pick, number one, the style of trader they want to be. They want to be a day trader. They want to be a scalper. They want to be intraday swing trader. If they want to be a short-term trader where you're holding over to, overnight, or if you want to be a daily chart swing trader or 4-hour chart swing trader where you're holding for a week or more, or if you want to do a position trader, which to me is I don't have that mentality to do that. I have too many things that show up on a chart that make me change my mind all the time. So I have a lot more opportunities because I think short term and I excel in the short term. That does not mean that that is not a proper way of trading when it's position trading. It's just I don't match that personality wise. So I like to excel where I'm strongest, and it's in intraday trading, and I can run the account pretty quick with velocity. I can get in, get short-term moves, and just parlay them out real quick, which is kind of like what I was demonstrating, facetiously this morning with the 1 minute video, thumbing my nose at the quant. So we're looking at the likelihood of potentially going back down below that level again. If it does, it'll probably start to accelerate. I like 13,300. If we get, on a roll going lower, I like that one. And maybe even if we get really excited, you can trade down into 12,000s. Okay, 12,850, 12,875 in that area. So just something to think about. I'm not suggesting you should take a trade in it or not, but just thinking out loud. This lesson obviously was a little bit fast and loose, and it will be a lot more structured on the market structure lesson on Thursday. Hopefully you found this one insightful. And I'm going to show you again, this was a trade I actually took with a live account. All right, so I'm going to log into my TD Ameritrade account. I'll show you a result of a trade I took yesterday. I have not taken any live trades today. Again, this is just to show real executions are being done. I like to teach with the demo, but just to answer the folks that are just really hardline critics or just want to know, can I push the button? Push the button, ICT. All right, so here is the business for the last 6 days trading. And again, this account is just to show what I believe a student could do. Now, right away, look at this right here. This is not a losing trade. It looks like negative $2,700.55, $2,755. What that is an adjustment by the broker, because at the time of settlement, when I closed the trade, it showed that I was up $4,920. And then because of their accounting, they were just showing that they were reflecting a gain of $7,675, which is not a actual realized result for me. It was them doing their administrative side. It's a broker thing. Trust me, I cannot do anything to make that happen. It's not me doing some funny money business. Okay, anybody that trades with live funds, they've probably seen this happen in their own account. So over here, you can see the executions yesterday. I had a scratch where I got in a little too early. I was a little ambitious. And then in the second one, I wasn't sure if it was going to go higher or lower. And just to appease my curiosity, I threw a short in just to see what we'd get. Snapped against me a little bit, not much, but still enough to get my attention. And I knew what I was looking for. So there's the short I just outlined in the previous portion of this video. Wrote all of that down, held for the gap opening after the reopen at 6 o'clock. And there is the close of the trade right there. Nice little dandy, $4,920 fixes the little pinch I took on the one trade earlier in the day. And the one scratch was nothing, it was covering costs. Okay, and again, there's the business there. That's the entry, and that's the exit. And there's no commission costs on the one above that. So you can see that was not a trade. Hope you found this insightful. Until I talk to you on Thursday, be safe. All right, folks, welcome back. I do hope everyone's doing well. So we're looking at episode 12. This lesson and lecture is going to be on the topic of market structure for precision technicians. Now, admittedly, going into this is an advanced price action theory. You're going to have a lot of questions. It's going to cause all kinds of anxiety for those that just feel like you have to learn it the first time you watch a video. Trust me, you will not and you cannot learn this in one video. Okay? This is actually going to be a lesson even my paid mentorship group has yet to see. Okay? So I want to give you something that's fresh, something that is deep, that will allow you to go into your charts and start studying a little bit more, well, deeper than the normal higher high, higher low idea that is made up of the retail view of market structure. All right, here is the NASDAQ March contract for 2022. I already hear some of you already hissing and moaning, the forex traders in my group. When are you ever going to talk about euro dollar? Well, let me remind you, what I'm teaching works in forex. Okay, it works in stocks, it works in bonds. It's up to you to decide what asset class you're going to work with. Okay, so I'm teaching price. This is the asset class that's moving around nicely, so I'm using it as a medium. Okay, you could just as easily go into a Aussie dollar, or pound yen chart, and you'll see these things happening as well. Okay, trust me, we'll get into forex again. Okay, I haven't abandoned the forex. I just want to mine this vein that's available in volatility right now with the index futures. All right, so obviously we can see, with the benefit of hindsight, that the things we were looking for in price action has come to fruition. We were looking for the run below these lows in here. We got that. We were looking for a run and rebalance back up into this fair value gap. It did so handsomely. Broke lower overnight with all the wartime things that are going around the globe. And you know what I'm referring to. That caused a little bit of excitement on the downside. And then we're back above this short-term low. I'm not convinced at this point that we have made a low. So that way we can put that to bed right now. I'm not in the business of picking tops and bottoms. So if you feel like you're going to go out there and do that, just let you know that I teach my paid group not to do that. And I don't go out there actively trying to do that either. But we're going to go into a deep dive of market structure inside this area. Now, before I do this, I want you to understand this part. This is the part that seems boring. This is the part that gets the most complaints from those individuals that will never, ever do well or succeed in this, because they want 5-minute trainers for something that's extremely technical, and you just can't strip it down to very easy ideas. Okay, so it's going to take a little bit of study, thinking, and homework of you going through old price data, and you'll start seeing these things. But I promise you, this video will cause a light bulb moment for you, and you'll start to see things that are in the charts all the time, but you are not aware of it. And it'll also allow you to go back into old moves and see that this is in fact very true. And you can use it to confirm or negate a price move. I get a lot of questions through TradingView, people posting, hey, can you answer this for me? Can you answer that for me? I don't make it a business of doing that because I don't have a lot of time for it, but I use those questions in these talking points in my lectures, not only in this mentorship, but in my private group. So the questions I get a lot is, how do I know if I'm going to sell above the old high? How do I know it's not going to keep going higher? Well, that's the underlying market structure and the trust in the factors that I'm going to kind of teach you tonight. Me teaching it to you is not going to transpose my trust. That has to be developed in your learning curve. It's going to take time. How long is it going to take? I don't know. All of you are going to do it differently, but you're going to arrive right on time. Exactly when you should, that's when you're going to get it all. Okay, and it's a matter of how much time and effort you put into studying it. Because these candlesticks, you can make them say anything you want. You beat on them and they'll submit to anything. But you want to know what they're likely to be hinting at, and I'm going to give you those clues tonight. But in here, we're going to take a deep dive into that price action right there. All right, so we are looking inside that fair value gap in the daily chart. This was the high end of that fair value gap, and this was the low end of that fair value gap. The time frame on this chart, as you can see here, 1 hour, and I've outlined market structure in the idea of long-term high, long-term low, short-term high, short-term low, and in between those two swing points, there's an intermediate term high and an intermediate term low. When we look at price, we're not looking for just the simple higher high, higher low, therefore it's a bullish market or uptrend. That's not what I'm looking at. I'm looking at, does the market have a reason to go up for buy side liquidity or buy stops? Or is it likely to go up to rebalance an imbalance, which is like a fair value gap? Or is it likely to go lower to sweep out short-term lows for sell side liquidity or sell stops? Or is it likely to go down to rebalance an old imbalance or a fair value gap below market price? That is the number one question that I have before I sit down in front of my charts. That's what I'm looking for. What is the current market narrative? What is it likely to be doing right now? I don't care about patterns in price action. I don't care about anything harmonic. I'm not looking for any kind of Elliott waves. I'm not looking for any kind of ratio idea. I'm not looking for anything that you can attribute to a retail mindset. Nothing except for those two questions. Is it likely to go up for stops or go down for stops? Or is it going to go higher to rebalance or lower to rebalance? Now, how do I arrive at that idea? Is it going to go higher or is it going to go lower? Because that kind of like leans on that question I told you many times. If there's one question I get asked the most, it's teach me bias. In other words, you want to know, where's the market going next? And that's good. That's the next draw on liquidity. But the daily range will not always submit to that bullish or bearish, right from the opening go higher or right from the opening go lower. Sometimes you'll have consolidation intraday, and you may have been trying to take a trade that was based on an idea that you came to that would be bullish. And maybe it did give you an opportunity to be in a trade that was profitable for a period of time, but you held on to it thinking the daily range was going to keep on going higher, and it turned on you. These ideas I'm going to teach you in this lecture here will help you identify the likelihood that your idea is probably been proven inaccurate, but you have to be receptive to the clues that price is giving you. That's the number one reason why I abandoned indicators. And if you have anything on the charts that cover up candles or draw your attention to something that you're putting on the chart, and I call that, facetiously lipstick, okay? That's what this chart is showing here. It's this lipstick. It's me communicating how I am internalizing this price structure, this fractal in price. I'm looking at it with this idea. Now, I'm looking at it in a matter of seconds. I come to this conclusion. I'm looking at the highs, and I'm looking at the relationships between each swing high, each swing low, and I'm coming to a conclusion, studying one swing at a time. And I'm going to come up with the idea that it's likely to go lower because that daily chart, I called it in front of all of you. I outlined, I told you where it was going to go. So that way we understand one another. I'm teaching something that I already proved before the fact. So it's not like me coming back to this area here, because if you haven't watched the videos prior to this, say you just found this YouTube channel and you're watching this one, it sounds like the typical guy that comes on YouTube and says, here's something that happened, and I can sound and look and appear smart because it's already happened and I have no real risk in being wrong. I told you it was going to go lower from here, and it did. Now I'm going to take you inside that price action and outline what it is that I look for, what it is that I looked for at the time, and how I felt confident it was going to go lower. Okay. So right away, we know that price is traded up to the high end of that fair value gap. And again, this level here is that daily chart. Let me go back up one chart. That's this level here. Okay. It's on this candle, that low. And the low of the fair value gap is this candle's high. Dropping down into the hourly chart, that's the high end of the fair value gap. This is the low end of the fair value gap, again, on an hourly chart. So that way we have our bearings. So when the market traded up into and just above that fair value gap high, this red level here, once it started to break down and go lower, it traded back down into this candlestick's high. So we're trading back inside this range, and we're range bound. Since I am expecting the daily chart to be the parent of this price structure, All minor lower time frame swings are going to be subordinate to it. And what does that mean? This now is a long-term high. I do not expect this high to be broken to the upside. Should it be broken to the upside, that means that my daily analysis, expecting this level here to hold price and to be a factor in the algorithm repricing and going lower at a later time, if it goes above that, then I'm probably wrong in my analysis. So therefore, I demand more information by studying more price action and sitting on my hands. Or if I have a trade on, it means that I have to admit that I'm wrong, and the stop out that may occur is just me managing risk. It's a losing transaction. It does not mean your model is flawed. It does not mean that you're a failed trader. It just means that that transaction was not a profitable one. And it's just a cost of doing business. But as long as price remains below this high, my idea is this is a long-term high because it's framed on what? A higher time frame resistance level, if we want to talk in terms of retail ideas. So that way we can understand something in a simplistic manner, but we'll build on the ideas that will help move you away from simple support resistance ideas. So this long-term high should remain intact. In other words, price should not go higher than that. We trade down to the discount level of the low end of that fair value gap. And it starts to find support, rallies back up, trades near the high, but does not take that out. Very important. Once it starts to break down and consolidate, in here, retail ideas will see a lot of trust in the idea that's potentially a bull flag. I love seeing those patterns because I like to fade them. So that's a false bull flag. And when we see price break down like this and then rally back up, every single time, this is important, this is the part where you start writing down these details. Every single time price rebalances an imbalance, like we have this candle's low, this candle's high, we have that one single candle passing down like that. Once that rebalances by going up here, that swing high from this high, and this high, that's a swing high right there. I immediately label that in my mind, not on my chart, because I don't want anything distracting me. If I have these things written on my chart at the time, it's going to be a distraction to me. But the way I'm internalizing it, and you'll see what I mean as I go through this lecture, every rebalance of an old imbalance, that swing that's created at that moment, I immediately label that in my mind as an intermediate term high, or in this case, as we came back down and filled in this by dropping down here, that's an intermediate term low. What does that mean? What's the significance of that? Typically, what you'll see is an intermediate term low has a higher short-term low to the right of it and a higher short-term low to the left of it. This intermediate term low forms by rebalancing, but it has a higher short-term high here, but then the market trades over here off of this short-term low. It rallies up, but it fails. It fails in here. We're going to anticipate that failure. Whereas if you're looking at this low, high, higher low, failed, higher high, higher low. So what's forming here? A pennant or a triangle pattern, right? How do you know which side's going to break out? That was one of the questions I had all the time as a developing student back in the 90s. 1992, 1993, I was buying every book I could get my hands on. And I got the book, the John Murphy Technical Analysis of the Financial Markets book, which is the retail trader's Bible. Okay, that book is so useful in terms of just reading it and knowing what not to do, because that's what the 90% crowd follows when they look at price action. Still to this day, because it's always regurgitated in some way, shape, or form. Someone's teaching that same idea, uptrending trend lines, which are so subjective. How do you know what swing low to attach for a trend line? There's lots of swing lows in here. How do you draw it? It's all subjective. So you have to have a way to reduce it down to, I hate to say it like this, but it really is no better way of saying it, but you have to break it down into a science. We don't do technical analysis. We do technical science. Okay, you have to be able to relate to certain things, weigh out and measure what these factors are within price action, which is not based on hypothetical guesswork or some kind of a harmonic animal pattern, which to me makes no sense. You have to look at the relationship to price action and the relationship of how it behaves. What is it indicating? What is it showing? The market has traded higher than consolidated. We failed to go above this important high back here. That's a long-term high. Then we have an intermediate-term high. Why? Why is this an intermediate-term high? Because we have a short-term high here and a short-term high here. So between two short-term highs, the highest high between those, that's an intermediate-term high. But the main takeaway for your notes so far is anytime a imbalance, like this big candle up, is rebalanced, that becomes an intermediate-term low. Just as well, on the opposite end, this down move here, that's a fair value gap. As soon as it rebalances there, that's what I classify as an intermediate-term high. Now, here's where we take a huge step forward. Classically defined by Larry Williams, you can see where I made a departure from his works, okay? It was very influential in the beginning of my development, and it was a point of argument internally with me when I was watching him teach it on his VHS course, the Futures Millionaires Confidential Trading course. That idea of his approach to market structure, he teaches a little bit of it in this book. Okay, so it's Long-Term Secrets to Short-Term Trading by Larry Williams. There's not a lot of books. I have over 2,000 some books, and I can tell you literally there's a handful of books out of all my collection that are useful. And I can't bring myself to throw them away because, number one, I paid a lot of money for them, and it's just nostalgia and me chasing all that stuff in books, and it's always the same stuff that never really works. The ideas that he teaches in this book here, they were taught in a early work by him in regards to market structure, how to internalize price structure, how to look at price not just from a higher high, higher low, because that's too myopic. Okay, it's a pursuit, especially in this generation today. It's a pursuit of simplicity for the sake of simplicity alone, not for the sake of getting to the truth or the heart of the matter. And that's what makes me a stumbling block for many of you that are younger, because you want right now instant gratification. You want instant reward for the menial time that you invest. When it's surprising to learn that you're going to take a lot more time than you first thought it was going to take to learn how to do this exceptionally well. But for an additional view on how I built this understanding in price action, it originally came from his idea of market structure. But if you study what I'm going to show you in this video lecture here, my paid group has never seen this before, and you're seeing it for the first time. Okay, so when you hear people talk about market structure and they're looking for a higher high, higher high, higher high, and having successive lower lows behind them, and then you have a failed higher high, and then it breaks the swing low right before that failed higher high, they look at that as a change in trend. Not all the time. Many times that's a good buying opportunity for me, because really that's just coming back down into a deep discount, and I'm going to buy those and continue it higher. So it's a little tricky if you don't understand the higher time frame, which is what those red levels are. That's higher time frame. The hierarchy in parent to child price swings. Okay, so that way the subordination that the smaller time frame price swings adhere to from the higher time frame is directly linked to the order flow on those higher time frame charts. So in other words, what am I saying? The daily chart has the bulk of the volume that's coming into that marketplace. There isn't a lot of volume coming in on a 1-minute chart. That's not to change the importance or reduce the importance, rather, of a 1-minute chart within the proper context and market structure that's underway. So you can use a 1-minute chart to navigate, because as a smaller retail trader, which is who we all are, but we don't trade with retail logic. There's a separation from what we're trying to do in price versus the collective out there that learns from books and things like that. Now, that may sound oxymoron because I'm pointing to a book right here on the screen, but the ideas that he teaches early in this book about market structure, I think, is the only thing that I found useful in that book. I have a lot of respect for this man, but out of that entire book, his discussions about market structure, that's the only thing I find that is useful from that book. So if you're reading anything else in that book, great, if you like it. But my only addition to this, for more research, for more of a foundational idea where I got this from, you're going to hear people say, he teaches Larry Williams market structure. No, I don't. The ideas that came early on in my learning came from this man's interpretation of market structure. But I want to take you into the chart now and show you what he's not teaching in that book, what he hasn't taught in any of his works. And it gets a little bit closer to the heart of the matter. And you'll find it's really interesting. So if we have an imbalance that's rebalanced and we have an intermediate term high, shouldn't an intermediate term high have a lower short-term high to the right of it and a lower short-term high to the left of it? Yes. Mr. Williams says so in his book also. What I discovered in my own study, no one taught this to me, okay? I kind of pioneered this idea. See a lot of these Instagram guys out there saying they pioneered something in the last 2 years of trading. The idea of a intermediate term high not being higher than the short-term high to the left of it or the short-term high to the right of it. In other words, it's going lower. This, an ideal scenario, should be this high should be above both short-term highs. But it's not. It's not. So what is it doing? It's only rebalancing this. And where is it likely to go? Well, if you're thinking in terms of a pennant or a triangle pattern, it's indicating to me, as soon as this candle starts to go up like this candle, and this candle. Why not this candle too? Well, this candle only has this low here. This candle is an up close, but this starts the last two up close candles right before this move down. This is important because we're going to look inside this shaded area and how we can use highly precise ideas within this order block. I'm anticipating this run up with these candles forming an order block where everyone else is teaching the idea of the last up close candle before the down move. That is not my order block. That is not my order block. So you need to stop teaching that because that's not accurate. Call it something else, but don't call it order block. This movement here, these two green candles that are going up, I'm watching these as they form live with the expectation, because this imbalance has been rebalanced here, this swing high is an intermediate term high. I do not expect this high to be taken out. So I'm already forecasting and anticipating a failed price swing in here. Every time this green candles are forming, I'm looking at that as a bearish order block. So from the beginning at that candle's low, I'm looking in time on lower time frame charts. Lower than what? Well, this is a 1 hour chart. So what's the time frame below that? I dropped to a 50-minute time frame. Now, before I get any further, just know that the range between this long-term high and this long-term low that range is going to be used for targeting purposes, and I'll get into that in a moment. But these up close candles, from the hourly perspective, that's the range for my hourly order block. Inside that range, I can be hunting fair value gaps. Light bulb. I don't need to see the market trade down below the last highest up close candle. I don't need that, because I understand what I'm looking for inside market structure, actual market structure, not just higher, high, higher, low. I'm looking at the underpinnings of the marketplace, and I'm examining what is it doing high to high, low to low, within a higher time frame premise. Remember, the premise was we were going to go up to this upper level here, rebalance, and then eventually trade lower down below sell side liquidity. In this fractal, I'm using this one here just to illustrate the idea. So in other words, up here, it's going to make a short pattern, something bearish to get short on. Then work towards going down to that low. Now, clearly you can see it here. It does so nicely. But I want to take you into this price action right here. Before I zoom in, look closely. What do you see? Pause the video. I'm not pausing the video, ICT. And you can't make me. All right. Right in here, you can see a small little imbalance. This one single candle like that, right there, that's the same thing that was occurring in this move here on the hourly chart that gets rebalanced there. Here, we have a smaller version of it. That is a fractal. That's something that repeats on a smaller or higher time frame that's similar in its formation. It won't be identical, but it's closely related to the general idea. If it trades back to this candle's high, don't worry, I'll zoom in a moment. That's your entry right there. That's aggressive. And I don't have a problem being aggressive if I know what I'm looking for. But there's also an imbalance in here. And it rebalances that right there. See that? Now, once we establish the market structure on that hourly chart, I'm not going down into the lower time frames below it and marking out all the swing highs and swing lows either. That's overkill. I just need to know what I'm looking for on the time frame I'm trading on. The logic is based on that daily chart that it's going up into this imbalance to go lower. The hourly chart frames my trade. It gives me what I'm looking for to start hunting entry techniques. Now, the 15-minute time frame, that's the bellwether. This is where it's going to give me the actual get in, get out. But I might not like the risk parameters that's required on this time frame. So I can go down into lower time frames. Should price go lower and break lower, I'm looking at that short-term low here and that in-range term low there. If we have a short-term low taken out and an intermediate term low taken out, or just an intermediate term low taken out, then we can go back to the previous long-term high, long-term low. Now, a long-term high and long-term low is generally going to be linked to a higher time frame daily chart. That might be a price range. It might be a high to a short-term low. In this case, I'm framing the idea and logic around that fair value gap that I outlined in front of all of you, saying it's likely to go up there, rebalance, and then go lower and take out that old daily low. There's lots of ways you can frame your trade, but you have to have something directly linked to that daily chart, because the daily chart, that's exactly what institutions are working off of. That's exactly what banks are working off of. That's where the money is. That's where your bias is going to be determined. That's going to be what makes or breaks your trend continuation, that daily chart. So the majority of your time and study should be on determining where that daily chart's going over the next day or two or a week. But you try not to forecast longer than a week. Not that you can't. I'm not suggesting that anyone can't do that. I'm just saying, if, as a developing student, you want to keep your perspective limited to a 5-day time horizon. And don't be upset if you don't have the entire weekly range forecasted correctly. That's not important right now. You're growing. You're trying to learn how to do this, and it's highly technical. When overnight, it took me 6 years. So, but it pays off if you stick with it. So if we have a break below an intermittent low, then we have what? A significant break in market structure. This is something that's more significant just simply than going into a chart saying, okay, well, it took out a short-term low, there it is. See how much more detailed this is? What this tells me is then I can start using this range high and low and start getting projections down. I can get a measurement of measuring this high to this low and start replicating that going down. And it'll give me price targets. They're generic price targets. If you don't want to use that targeting method, this long-term low to intermediate-term high, if price breaks below here, as it does here, you can simply take your Fibonacci, anchor it to the highest high, down to the lowest low, and this is what you would get here. Why am I using that? Why am I not using this here to here? Because this return back up, this is where all of this move starts right there. This is just the beginning of the framework. This is where the swing begins on the decline. Follow what I'm saying? I'll say it again. This high and this low, that's your framework. The retracement that fails, that starts the decline, begins here at the intermediate-term high. So if you anchor your fib to the intermediate-term high down to that low, which is a long-term low, the projection is -1.5 standard deviation, and there's your low. How much lower than this can it go? That's one way of determining it. Now I know what you're asking. What is your fib settings, ICT? There's my fib settings. Okay. I don't toggle everything because I don't need all the lines, but I'm looking at measurements like this with logic behind it. It's not just me randomly going in there because I get a lot of questions. When I was on Baby Pips, I got lots of emails all the time, and people would post in the forum, why are you anchoring your fib to that swing high and not in that swing high and not this swing high? This is what I never taught. This is what I'm showing you today. This is advanced market structure. This is not something you're going to find in books. Mr. Williams, I'm sure, doesn't even know it like this. He's rather simplistic in the way he does things. That's the only thing I've really gleaned from him. He's a legend, don't get me wrong, but he does things rather simplistic. But because of my background is computer programming and computer science, and I have obsessive compulsive disorder, I need to know why things do what they do. And I need to know everything. Now, I don't know everything, but my pursuit of knowing everything led me to look at markets like this and internalize what the algorithms are doing, because there has to be a rhyme and reason, right? Like, to suggest the idea that these markets are operating under an algorithm and they're going up and down based on an AI, artificial intelligence is controlling this. It's not your buying and selling pressure. I've said this many times before, but if that is true, and let's suspend your disbelief if you don't believe there's an algorithm, just for the sake of this conversation, let's just say for a moment that you do subscribe to the idea. If there's an algorithm, that means it must follow some form of logic. And how does it reference how far to go up and how far to go down? It cannot see your stop. It doesn't see Michael's stop. It doesn't see Renee's stop. It doesn't see Juan's stop. It doesn't see Brian, Larry. That's outside of its capability. But it knows where people will have their stops based on these ideas. Short-term high, short-term low. Intermediate-term high, intermediate-term low. Long-term low, long-term high. And where the imbalances are. Now, I already know right now, at this moment, right now, your heads are spinning. You're probably sitting here looking at, man, this is crazy. How did he come up with this? And how the hell am I going to use it? Exactly. You're going to take time learning this. Line upon line, precept upon precept, here a little, there a little. It takes time to do this, okay? But I got requested to teach market structure, and this is my interpretation of market structure because I'm leaning on algorithmic principles that are in the marketplace that can't be taught to you, but I'm creating a language so that way you can see it visually in your chart and you can measure and reference certain things, not exactly like the algorithm does, but very, very close to what it's doing, which in my mind doesn't really step on anybody's toes now, does it? So if we're looking at this little shaded area here, I want to zoom in now and get down to the heart of this teaching. This is the same 15-minute time frame, and just zoom in a little bit more. This is an aggressive entry for going short. Now, that hourly chart was showing those two candles going up. In the 15-minute time frame, it's obviously more candles. So in this up close candle series of 1, 2, 3, 4, 5 candles, in that range, if I get a fair value gap form with a breakdown like this, notice I don't need a swing low broken. Notice that? In the model I'm teaching you, you have to look for what? The short-term low being broken. That's your market structure shift. Then you see price go up into that imbalance, and then you can go short, or vice versa when you're going bullish. If you understand market structure with this perception, looking at it from a higher time frame and anticipating a breakdown, but then starting to classify each imbalance and swing high and swing low, intermediate term highs and lows are formed at the rebalancing of an imbalance. Everything I already said in the video. Okay, I'm just reiterating. If the intermediate term high is not higher than two short-term highs, that is telling you that the market is very weak. And the algorithm is tipping its hand to those people that are looking at it like this. Who would be looking at it like this? Smart money traders. Someone that's not looking at a chart with harmonic ideas, nothing Elliott wave. They don't even look at support and resistance. That's not a factor. That's not a factor at all. When bank traders sit down, they're not looking at support and resistance. They care less about a trend line. They don't care about moving averages, crossing over. None of that stuff. They're looking at imbalance, rebalance, and liquidity. That is it. That's it. That's all they're doing. Now, framing that within the context of forex, they would be utilizing the fundamental idea of interest rate differentials, which I'll talk a little bit about. Not in this lesson, but I said we go into forex. But right now, we're teaching price through this medium and index futures.